It's actually been crazy how fast it has caught on and how useful Bitcoin's been for, everyday people.
Just to buy something as simple as a cup of coffee can be done quickly, painlessly.
Are you still committed to the U.S. pickup market? You mentioned how small it is, and I know you do good business at Frontier, but a lot of times Americans want something bigger like the Titan. Is that, do you plan to stay in that market as competitive as it is?
I mean, for us, market is one thing. The second is what customer aspires for from Nissan. And customer in United States aspire for sedans, SUVs, and the pickups. And Titan is a great pickup truck, and we are, of course, focusing on the Titan. But as I said before, that in our whole lineup, our main focus is always been in the sedans and SUVs and the smaller pickup truck.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Probably we will remain in shortages for the next months or even years, because semiconductors are in high demand, Internet of Things is growing, and the capacity ramp up will take time. So it will be probably a bottleneck for the next months and years to come.
And years to come. That was Herbert Diess there of Volkswagen from New York City this morning. Good morning. Alongside Lisa Abramowitz and Katie Lyons, I'm Jonathan Ferro. Your equity market shaping up as follows this Tuesday morning on the S&P 500, totally unchanged. This is where the lift is. Yields, treasuries. Yields are higher by 4 basis points. Treasuries are lower to 136.30. Lisa, yields are higher. That's a steeper curve.
Yeah, a lot of people thinking that perhaps this has to do with the Fed remaining on hold for longer. That allows inflation to rise in the long end. I do wonder at what point this does become a concern for equity investors and other risk assets.
That is a theme for us this morning. Another theme is over in Munich with Matt Miller. This is a day in the life of Matt Miller. Matt, I'm not even sure we can call this a day at work for you. Good morning, Matt.
Well, you know what? If you love your job, then you can't call it work, Jonathan.
Oh.
I am having a fantastic time.
Matt.
This is my first time back at an auto show since March of 2019. So I'm happy to be back in my element. But this show is less about cars and much more about tech than it ever has been before. I'm talking here with Cristiano Amon. He is the CEO of Qualcomm. Cristiano, it's great to talk to you because all of the automaker CEOs I've spoken to over the past 2 days have been focused on chips. You must feel like the most invited dinner guest. How is it going with your business, especially considering the bottleneck, the supply chain issues that we hear so much about the last couple of days?
Well, no question, chips are important. We're very excited in general. It's not just because of the importance of chips in the current situation. Car companies are becoming technology companies, and that's why Qualcomm is here. Automotive is one of the fastest growing business for us. We just announced the last earnings call, we have over $10 billion of automotive dedicated revenues in the backlog. It's over $1 billion of revenue in this fiscal year. And we're partnering with the automotive companies across all domains of transformation, connecting the car to the cloud, the whole in-car experience, and of course, autonomy and ADAS. Very exciting time for Qualcomm.
I know your chipsets are being used in Ducati motorcycles. I've been able to experience the first blind spot detection as well as automated cruise control on a motorcycle, so that's quite cool. In terms of the broader industry, the slowdown seems to be lasting longer than had been expected, and CEOs are telling us 6 months to 12 months, probably deep into 2022 until it gets sorted. How is it with Qualcomm?
Well, let's talk about this. You know, there is a new reality across the board that the percentage of digital component of the economy is higher. I think we all saw the pandemic accelerated digital transformation of many enterprises, and the automotive industry wasn't immune to that. So we're actually excited about the opportunity. This demand is here to stay. Of course, we're short in all technology across our industry, but the good news, you know, we put our scale to work. We have been investing with our suppliers in new capacity, and we expect material supply improvements as we get at the end of this calendar year. So we're going to enter 2022 with a much more balanced supply-demand equation.
Can I ask you about some M&A? Your competitor, NVIDIA, wants to buy ARM for $40 billion. The FT reporting today that regulators are concerned NVIDIA isn't going to allow everyone equal access to ARM chip designs. And why would they if they're paying $40 billion for it, right? What are your thoughts on the possibility of a less open ARM climate here?
Look, we're being very consistent in our position about this, as well as many other companies. There are leader, implementers of ARM technology. ARM already won. ARM won on mobile devices. The CPU is ARM. Automotive's moving to ARM. Computers, it's an ARM. The data center's moving to ARM. So ARM has been quite successful. And because it was an independent company that was able to rely on the collection of R&D investments of this broad ecosystem. ARM's a great company. We love an independent ARM. We think that is the reason for its success, and that's what the industry needs in the future. We'll continue to believe an independent ARM is a better solution for everyone.
Well, what happens then if NVIDIA gets control of the company? Aren't you concerned that they would limit your access to ARM designs?
Look, at the end of the day, we trust that the regulators are going to take this serious, and as digital, as we talked about earlier in the interview, as digital is now important for every industry, we need to have a competitive, an open, and a transparent ecosystem, especially if anybody has a dominant position on the instruction set like ARM does.
I got to ask you about China as well. Starting a few months ago, regulators in China were changing the rules from fintech to Didi to video games. Every couple of days, it seems like there's a new set of rules in China tech. How does Qualcomm work in that kind of environment?
Look, I think I have something else to say. Our China business has been great. We have a fast-growing, stable China business. The number of partners in China for Qualcomm is increasing. We always been, partnering with them in the mobile industry. Right now, we saw, companies like Xiaomi, Oppo, Vivo are growing with the 5G transition. Xiaomi just became the number 2, smartphone manufacturer in the world. But on Auto, we now have 10 customers in China. So the number of partners in Qualcomm continue to expand. I think we're very fortunate to have a relationship with China that may be a model of what stability look like. We participate in growth in advanced technology. The China respect intellectual property of Qualcomm, our patents are licensed to all Chinese companies, and we're generating growth for us and for our Chinese partners, and we expect that to continue.
In terms of the broader global growth picture, this rebound has been hampered a little bit by the resurgence of the Delta variant. How does it look to you?
Look, we are fortunate for being the technology space. What the pandemic did by work from anywhere, the enterprise transformation of the home, and then the acceleration of digital transformation because the companies want to connect their assets has created a boon for technology companies. And we all want us to get out of this pandemic. You know, it's way overdue for us to get out of the pandemic. So happy to be here and seeing a lot of people. But the reality is some of those technology transformation are here to stay. Connectivity is becoming essential. And, you know, we're going to continue doing Teams and Zooms and those type of meetings for a long time.
All right, Cristiano, thanks very much for your time. Really appreciate it. Cristiano Amon, the CEO here of Qualcomm at the Munich Auto Show. Jonathan, talking to us about sticky technology transformations that we saw during the pandemic, talking about hopefully some relief in the chip space by the end of the year, as well as being content with their position in China.
Hey, Miller, good to see you, buddy. Great work, as always. Lisa, not lost on anyone the importance of talking to a chip maker at an auto meeting.
That says everything. And this is no longer an auto meeting, but rather a mobility plan, a mobility conference. And that says everything you need to know.
Equity futures unchanged this morning on the S&P 500. Good morning to you all. Alongside Lisa Abramowitz, together with Katie Lyons. I'm Jonathan Ferro. This is Bloomberg Surveillance on radio, on TV.
After 16 years in power, actually, remains one of the most popular, if not the most popular, German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
Power of Bloomberg.
Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report. The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance. This Tuesday morning, Wall Street getting back to work and futures basically unchanged on the S&P 500. On the Nasdaq, we're negative about 0.1%. A similar move on a Russell, down 2 points there. Let's call it 0.1% lower. Off the back of 2 weeks of gains on the S&P 500, muted price action after the long weekend. Let's switch up the board and get to the bond market. Three numbers to think about: 58, 38, and 24. 58 billion of 3-year notes coming later. 38 billion of 10-year notes coming tomorrow. 24 billion of 30-year notes coming after that. A ton of supply through the week. Just as yields start to pick up going into that, we're up about 4 basis points on 10s to 136.13. On 30s by a similar amount, 197.64. Following that downside surprise on a payrolls report on Friday, steeper curve off the back of that, steeper curve again. 2-year anchored in and around 21 basis points. The yield curve at the long end, 10s and 30s, yield starting to pick up just a little bit more. So look out for supply through the week. Look out for the ECB too. Let's finish on that. Euro dollar. German investor confidence, the ZEW sentiment survey, if you follow that. I know you do in Europe. Stateside, maybe not so much. Euro dollar 118.63, basically unchanged, Lisa, going into the ECB, which we'll talk a ton more about as this week grows older.
No doubt. One of the more interesting meetings of the ECB as they plan to potentially talk about their plans to taper. John, thank you so much. Right now, I got to say, this is the interview that I've been looking forward to for a very long time. Adam Tooze is a Columbia University professor, author of Crashed in the Past, which really tracked what we saw past a couple of years in terms of the economy post-crisis. Now he comes out with Shutdown, how COVID shook the world's economy. And Adam, in some ways, you are one of the preeminent, if not the preeminent historians of fast-moving current financial history. And I'm wondering how difficult it was for you to get your arms around the shutdown and reopening that still has beguiled economists to this day.
It's a really tricky problem. I mean, no one should kid around about this. Writing history in real time is a risky kind of business. I don't expect this book to last forever, but I guess what I did was to start with the main event. And the main event is a news story that I think the general public is just not aware of to the extent that they need to be, and it goes directly to the market you were just talking about, the US Treasury market. That's really what we need to put across, right? The incredible seismic tremor that we saw in the most important financial market in the world, the anchor of safe assets globally, the US Treasuries, which were in chaos in March in 2020. And the book, in a sense, is an effort to think through from there the stabilization effort that succeeded to an extent, but also its limits. So that's kind of the shtick of the book, is to say, right, well, this is one dimension of the crisis we could get our hands around. What about the rest?
Well, let's elaborate on that. I mean, what does the public perhaps not appreciate with respect to the seismic shift that we saw in March of 2020 in terms of the ramifications of what the Federal Reserve did?
Well, the money was going the wrong way, right? In a panic like that in 2008, you really want the money to go somewhere safe. And the place that we think of as safe is the 10-year Treasury, 30-year Treasury, American government IOUs. And the problem in March is that even those were selling, and then the market stopped functioning. So the bid-ask spreads blew out. You basically couldn't liquidate the thing that you count on as being absolutely liquid in your portfolio. And that then unleashes a chain reaction. And frankly, if that had, fully burned through to the extent it was threatening to do, we don't really have a map for that terrain. And you get a sense, I think, of just the sheer panic on the buy side. I mean, the Fed steps in, and by the end of the month, early April, they've bought 5% of that crucial market at a pace, at a rate that vastly exceeds what we saw in 2008.
Professor, we've had a massive policy response in the last 18 months. You know that, I know that, we all know that. How would you characterize the compare and contrast between what the United States has done and what China did?
It's very surprising this time around, right? Because if you go back to 2008, China's the big actor, the surprise actor. It really turns the tables on the Western world with a giant fiscal stimulus, which, as we all know, in China is a kind of weird blend of bank lending and regular fiscal policy. This time around, because the Chinese contained the epidemic so much earlier, and because also they got a giant debt bubble to worry about, think about Evergrande, The Chinese response is more muted. They're more successful, if you like, in containing the epidemic. The US, on the other hand, is hyperactive, and not just on the monetary side, of course, on the fiscal side too, which is then leading to that huge supply of bonds that you were referring to just a minute ago.
Is there a blueprint here, Adam, for how we deal with the next crisis? And can we really compare China with the United States, an authoritarian regime with a democracy?
We have to find our own way forward in the West. I really think those comparisons are unhelpful. We need to understand that China's in the world. Our biggest single mistake in January and February last year was to imagine it was their problem. They were going to have to solve it their way. It didn't concern us. You know, what was happening in Wuhan had no implications for JFK. Disastrous miscalculation. As to the actual solutions, we have to do it our own way because the systems are so radically different. And what we've really got to think about is how we, as it were, multiply the kinds of chains of competence which we did display. Think about the vaccine development program, think about the financial policy response to other areas, which is where we really signally lacking in the ability to organize a collective reaction to a disaster like this.
Adam, when you talk about the monetary policy response in your book, you call it an emergency action of the most radical kind and pose the question, what was now normality? Can we ever return to normal monetary and fiscal policy, or is the role of central banks now forever changed?
That was a rhetorical question, bad academic habit. I think probably not. Like, that's really the message of the book is, I mean, the final line of the book is literally, we ain't seen nothing yet. That, I think, is the crucial takeaway from this. I mean, this wasn't even a bad pandemic by the standards of what the virologists and epidemiologists say is out there coming our way. And we know the kind of cosmic macro risks of climate change and how complicated those are going to be to cope with. I think we have to let go of that idea of the 1990s, 1980s, 1990s independent central bank with a clear separation of fiscal and monetary policy. That isn't our world. It hasn't been our world since 2008. And even in 2019, think back before the crisis, it wasn't obvious how either the ECB or the Fed could really pull back. You know, they could raise interest rates a little bit, but then we know how ginger they got about that and how they had to pull back. The ECB was doing mini QE even in the fall of 2019.
Adam, you also talk about how 2020 was a year of acceleration in so many trends, and you talk about how it's just really a moment in the process of escalation and the great acceleration is going to continue. Looking at that from a labor market lens, have we arrived sooner at structurally lower participation? Specifically, I'm thinking of the U.S. economy, but in general.
I do think the US has a particular problem here. It's a little bit standout. If you compare the US to other similar advanced economies, really bizarre inversions of historic trends with Japanese female labor market participation trending above that of the US. There are, I think, some real issues. American society has to have a long, hard look at itself and think about the kind of politics that would change this, because this is directly tied up with the social justice piece, with the racial justice piece. The low participation rates that show up in these, as it were, cold numbers for low participation, especially of men in prime age, are really a symptom of social dysfunction. This is an issue that has to be addressed through things like the criminal justice system, through education, through the rollout of high-quality vocational training for a whole sector of the population. That's, I think, where those solutions have to be found.
Well, to tie this all together, Adam, when you say you ain't seen nothing yet, are you talking about perhaps bond buying by the Federal Reserve? Are you talking about negative interest rates? Or are you talking about essentially a combination of everything that comes together, basically in modern monetary theory on the fiscal side, working in tandem with the Federal Reserve?
This is what I call a polycrisis. It's all of those things. But the really harsh lesson that this crisis taught us is that printing the checks is really the easiest part of this. The MMT folks are right in a sense that we can afford anything we can actually do. But the problem is actually doing the things we need to do, figuring out how to do the infrastructure, figuring out how to make public works work, figuring out how to do adequately scaled vaccine programs, and organizing the politics around that, because actually doing things in a society that's complex like in the United States depends on functional politics.
Adam, let's tie this one up and put a bow on it. You and I have just talked about the different economic and political systems to address this crisis, China going one way, the United States going another. For a long, long time, we talked about China becoming more like the West. And I think what surprised me personally, and I'd love to wrap things up with your view on this, is how much some countries in the West are starting to behave like China. I look to Australia every single morning, almost in shock, with some of the things that they're discussing and the things that they're doing. Adam, what's your response, your reaction to what has happened in the West and how some of these countries have responded maybe more in the traits of an authoritarian regime than maybe one you'd expect from a democracy?
I do think we have to reckon with this. It's a trend that is, I agree, extremely alarming. We've all accepted prohibitions and restrictions on our activities that would have been unthinkable 18 months ago. The fact that we're not even in the same studio, for instance, would have been very surprising to most people. And I think for us, the answer may be through politics, it may be through law. If you look at the track record of 2020, the magic bullet here, the thing that really gets us out of jail, is technology. And I don't say that glibly. I say that not in the sense, if you like, as some sort of techno-optimist booster, but as a kind of desperate last resort. That is the one thing that worked for us. And so really, I think the question's got to be, how serious are we about that science push? Because right now, if you look at the R&D spending figures, we're not even in the ballpark, in the order of magnitude that would be necessary and that would indicate that we were serious about these problems, be it climate, be it pandemic risk. We need to be spending hundreds of billions of dollars. When you say that, you realize, I don't even quite know how you would do that.
Yeah.
That's our problem. How do we scale up these pipelines?
Professor, such a good final point, and let's catch up again soon. Really enjoyed it. Adam Tooze there of Columbia University, professor and author of Shutdown, How COVID Shook the World's Economy. Writing history as we're still writing history, Lisa, in many ways.
Yeah, although pointing to some of the response, and frankly, I find that interesting, the idea of wither central banking going forward at a time when they already have printed a lot of cash. They've already expanded their balance sheet past $8 trillion. What comes next? Are we looking at negative interest rates? Are we looking at just a balance sheet to infinity?
What comes next on this program? We're going to discuss this pandemic. We'll do that with Dr. Amish Adauja.
Well done.
Johns Hopkins. I didn't want to weigh in, Lisa.
Evidently.
No, just
graceful.
Negative rates forever. QE forever. Maybe.
I mean, I'm just saying.
I know you're just saying. Equity futures, S&P.
Look at those markets.
Yields up by 4 basis points to 136.30. From New York City this morning, good morning to you all. With the wonderful Lisa Abramowitz and Kelly Lyons, I'm Jonathan Ferro. Tom Keane back with us. When's he back with us? On Thursday.
On Thursday.
On Thursday. Couple of days off. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden needs Democrats in Congress to give him a boost by passing his $4 trillion economic agenda, but divisions in the party threaten the chances of that happening anytime soon. Democratic progressives and moderates are at odds over the size of the tax and spending package. Meanwhile, there's a battle coming up with Republicans over raising the debt limit. It's one of the most contentious issues of Brexit, the UK's extended post-Brexit grace periods for trade between Great Britain and Northern Ireland. British officials want the EU to rewrite a part of the Brexit deal that effectively keeps Northern Ireland in the bloc's customs area. The Biden administration has approved financial aid for areas in New York and New Jersey devastated by last week's flooding. The remnants of Hurricane Ida caused tens of millions of dollars in estimated damages to public infrastructure and property in the region. Meanwhile, more than 40 people died in the storms and more than 1,000 homes were damaged. And Bitcoin faces the biggest test yet in its 12-year history. El Salvador is becoming the first country to adopt it as legal tender. The country bought 400 Bitcoins ahead of the rollout, worth about $20 million. The question is whether a significant number of people want to do business with Bitcoin when it circulates alongside the US dollar. And aluminum traded near the highest since 2011 following a military coup in Guinea. The West African nation is a major producer of bauxite, a key ingredient in the metal. China imports more than half its bauxite from Guinea. The leader of the coup called for continuity of production in mining. He also said existing mine agreements will be honored. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
somebody said, I want to be the next Reid Hoffman, what would you say is the best training ground to do that?
Well, I'm still young enough that I'm still hoping to be the next Reid Hoffman myself.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The question I get asked the most is when vaccines will be available for children under 12. And that is a question I cannot answer because we don't know the data yet for kids under 12. And hopefully we'll have some of that data and the FDA will be able to share it transparently.
That was Joshua Shafstein there of Johns Hopkins Bloomberg School of Public Health. From New York City this morning, good morning. Alongside Lisa Bravitz and Kelly Lyons, I'm Jonathan Ferro. This Tuesday morning, remember the day we're on, equity futures are down about 2. We're basically unchanged to the S&P 500. Yields are higher by 4 basis points on 10s to 135.96. That is a steeper yield curve in America off the back of a downside surprise in a jobs report. Started this morning by having a discussion about whether we're downgrading September, the importance of September already. This was a quote that came from Continental over the weekend, Lisa, at the Munich Auto Show. The chip supply shortage and rising raw material prices will weigh on the automotive industry for all of 21. And we thought Q4, the end of Q3, was going to be the start of this story getting better. And now we're talking about the back end of 22. And I heard this morning, Lisa, from one manufacturer, from one auto company, that perhaps it's into 23.
And to me, this is one of the key questions. And not only that, but there was actually an interview in the Financial Times with one of the port operators, one of the biggest port operators, who said the problem is just there's too much consumer demand as a result of all of the stimulus checks. That needs to stop in order for some of the supply chain disruptions to get righted. That is shocking and goes to the slowdown point if consumer demand slows.
Kelly, do you get that story, that tone early in the morning with Francine, with Matt, that when you speak to some of these leaders in industry, that this story of the end of 21 has quickly become the end of 22, maybe going into 23?
Or even farther down the road, John. I mean, Matt Miller spoke with Herbert Diess, who is the CEO of Volkswagen. He said we could potentially be looking at these chip shortages for years to come because he talked about the Internet of Things, and these cars are becoming so high tech. They require so many chips that there is always going to be that demand for them until supply can catch up to that. There are going to be shortages for a lot longer than the next couple of months, John.
The Delta variant not helping things at all. Let's bring in the doctor, Dr. Amish Adalja of Johns Hopkins Center for Health Security. Doctor, I want to go to just a basic question. You can give me the nuance. Just how bad are things right now in this country?
It depends upon what state you're in, because what we've seen is kind of a two-track pandemic, the pandemic of the vaccinated and the pandemic of the unvaccinated. And the pandemic of the vaccinated is not really a thing. And what we've developed now is a regional threat from COVID-19, and it's not the same systemic threat that it was. So ICUs, for example, in the Northeast or Pittsburgh, where I work, are in a very different position than an ICU in Texas or an ICU in Mississippi. And that has to do with how many high-risk people have been vaccinated or have immunity from natural infection. And what we're seeing is that ICUs are not under stress, for example, in the Northeast, but they're under real stress when it comes to Florida, Texas. And we've got kind of this cluster, these states basically from Texas to Georgia that comprise most of the hospitalizations. And while the numbers are high, over 100,000, they're really clustered there rather than spread out across the country the way they were in the winter.
We're also seeing record numbers of children being hospitalized. This has to do with just this is a more infectious variant. They're getting infected more frequently. What's the data on whether they are getting sicker from this variant?
There's no evidence the Delta variant makes a child or anyone really more sick. There's some anecdotal information and that there may be increased hospitalization rates in adults, but that hasn't been replicated in every study. But for children, it's just, as you said, it's a fact that there's a more contagious variant out there. Children are back to their activities and they're getting infected. And the Delta variant will find you if you're unvaccinated. And it just so happens that children have lower vaccination rates, even among the children that are eligible to be vaccinated. And then those under 12 are ineligible to be vaccinated.
We're talking about booster shots now, the U.S. recommending it. However, it has been delayed. There is a question whether this is actually a 3-shot vaccine, not necessarily 2 shots and a booster. What's your view?
For the immunocompromised, it certainly is a 3-shot vaccine. For those that are healthy, I think this is something that we're all debating. We don't see strong clinical data that prompt the need for a 3rd dose at the 6-month or 8-month or on the September 20th interval. And that's why there's been pushback on the Biden administration's plan to do this, because there isn't data that's showing, yes, antibody levels decline, but that confers a risk that's intolerable or that can be ameliorated by getting a vaccine. To me, the threshold for a vaccine is seeing people who have breakthrough infections land them in the hospital. That's just not happening amongst healthy individuals. So that's why this isn't something that's a foregone conclusion. And the problems we have in the United States are not caused and won't be solved by 3rd doses. They'll be solved by 1st and 2nd doses.
And given the number of people in the country who still have not gotten their 1st or 2nd dose of a COVID vaccination, how much room is there for the case curve to continue to climb, or are we nearing a peak?
In many of the states that got hit hard with the Delta, so Texas, Mississippi, you've seen cases fall over the last 2 weeks. And that's what Delta tends to do. It tends to infect about 20% of the susceptible population that happen to be the super spreaders in a given area, and then it falls. So they're all sort of peaking. But there are some states where we're going to see cases continue to increase. And that's to be expected, because remember that cases are, in many places, going to be somewhat decoupled from hospitalizations because it's younger people getting infected, younger people who aren't vaccinated. So we may see kind of a different timeline in different states. But it seems that the worst in terms of cases is over in places like Mississippi and Texas. However, they're going to take some time to decant their hospitals, and we will continue to see deaths rise in those states because deaths lag cases.
Doctor, the president has called this the pandemic of the unvaccinated. Some people might point to Israel and say something else is going on here. Do you think calling it the pandemic of the unvaccinated really captures what's going on right now then?
It exactly captures what's going on, because if you look at the states that have the lowest vaccination rates, that's where they're in the most trouble. It is unvaccinated people that are spreading it. The Israeli data is hard to sift through, and there's a lot of statistical paradoxes in a highly vaccinated country where older people tend to be vaccinated more than younger people. And when you kind of look through all of that data, and this is why the U.S. wants the raw data, the Israeli data tells you the same story, that vaccines are actually working. And remember, breakthrough infections that are mild, breakthrough infections that are like the common cold, often the result of aggressive testing, aren't that significant. They're not the way we kind of have an off-ramp of this pandemic, because if we're chasing mild illness in fully vaccinated individuals, there's no way to stop this pandemic, because we're going to be continuing to do that. The goal is really to defang this virus, make it unable to cause serious disease, hospitalization, and death, and that's what the vaccines are doing. And I think that our data here in the United States bear that out, and I think if you sift through the Israeli data, you will also see that when you really look at the statistics there and see exactly what's happening.
Doctor, we appreciate your expertise this morning. Dr. Amish Adalja there of Johns Hopkins, capturing the difference between, say, the UK and the United States right now. And many people have used the UK model from a market's perspective, Lisa, as a model to say that in the United States things will fade pretty quickly. This is a key difference. About 18% of Americans 65 and over still aren't fully vaccinated. The number's 5% in the UK. And in our write-up, there's a very strong suggestion that that difference of 5% and 18% makes a big difference.
And I think that that's basically what Dr. Amish Adalja was saying, that basically it absolutely captures the state of play when you say this is a pandemic of the unvaccinated, because it ultimately comes down to the hospitalization rate. And when we start talking about perhaps something other than the hospitalization rate, if there is no longer that stress on doctors and nurses that are increasingly short supply in some of these most affected areas, that's when we know we're actually at the end, John, and we're not there yet.
We're not there yet. Hopefully we're getting closer. Katie, you've been counting the days, haven't you? How many days since we've had a 5% correction?
Over 200,
S&P
John.
500, more than 200.
Yeah.
Before I even complete the question, Katie, thank you. This
knew what you were
equity
gonna
market run is doing okay, isn't it? Considering the conversation we're having, Katie, on a daily basis.
Yeah, continuing to climb that wall of worry, John. The question is, how long can it last? And is it predicated on a Fed not making a move this month, maybe pushing it out further on to the tail end of the year?
Yields are higher, up 4 basis points on 10s to 136.13. The curve is steeper. Equities are down 2 points on the S&P, essentially unchanged. On radio, on TV, for our audience worldwide, as Wall Street gets back to work, this is Bloomberg. Happening on the ground right now, just in terms of consumer price tolerance?
We see a strong consumer right now, and you can see that even in the early starts to back to school and back to college season that we're really pleased with. And I think if we step back and look at the quarter, you know, we see the evidence of that strong consumer.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The whole economy is broken.
broken. I mean, we can't find the labor we want, and there's disruption.
It's not so surprising that momentum is slow. It's just surprising that it's all been lumped into this quarter.
The reality is it's not an economy moving to a new higher sustained level of growth. Nothing structural has really changed.
The curve has flattened significantly. It's almost the market saying the Fed is exiting no matter what.
The most important thing not to lose sight of here is the emphasis that tapering is not tightening.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Wall Street getting back to work from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Lisa Abramowitz and Katie Lyons. Tom Keene is going to be back a little bit later this week. I'm Jonathan Ferro. Equity futures totally unchanged on the S&P 500 off the back of a second week of gains. Lisa, we've downgraded September in a big way.
We've downgraded the importance of it. We've downgraded expectations for growth, as well as how clear of a read we'll actually get on the labor market returning in a way that sort of remedies some of these frictions that we've seen. I am also wondering, John, as you talk about record highs and the incredible momentum behind the S&P, this idea of when does the market reflect the economy?
Well, Jonathan Golliber, Credit Suisse, what did he say at the opening of this program? The economy is still broken, and there's a man who's very bullish this equity market still.
And how much is that the reason why people are still so bullish? If the Fed's going to remain pat, and a lot of the companies that represent in the S&P 500, perhaps more dominantly, are ones that will do well no matter what, and that's big tech.
You know what we don't even talk about anymore, Kaylee? We barely even talk about D.C. and a fiscal effort down in Washington. It barely even comes up. It's not even on the radar for many guests.
Yeah, well, we also do have Congress people who are still on their extended recess. Yes, the tax writing House Ways and Means Committee will start working on some of that language this week, John, and we still are getting commentary out of the likes of Joe Manchin. He is not on board with $3.5 trillion. He thinks the price tag is too high. So there's a question of whether or not you can agree to that amount of spending. And then there's the question of how you pay for it and what exactly are we going to see in terms of tax hikes. That may be a risk that this market has started to underappreciate a little bit, John.
Extended recess, Lisa. I thought summer was over. Who's on extended recess?
All of Washington, D.C. They
have
don't
their
have
own
to
summer.
come back. Well,
can they wear white?
That was what I was going to say.
When they get back, they can do that still?
They're trying to be by themselves.
Different
Hang
rules.
Out in
Equity
white.
futures this morning on the S&P 500, totally unchanged on the S&P. Really muted price action as we kick things off this Tuesday morning. With the exception of maybe the bond market, yields are higher by 4 basis points at the long end on 10s, on 30s, the 2 years anchored. You've got a steeper curve here. Lisa, the 10-year, 136.30, going into a ton of supply this week, 3s, 10s, and 30s.
Yeah, and you do wonder how high that can climb to, at Kaylee's point, before that starts to create a little more action in the S&P, perhaps a little bit more of downward sentiment. Today, what I'm looking at is what's going on over in Germany, over in Munich, not Frankfurt anymore. Angela Merkel, the chancellor, is kicking off the IAA mobility trade show. It is not an auto trade show anymore. It is mobility. People are looking at chips. People are looking at the technology behind the cars. What I find interesting is how much we're going to hear from the likes of Qualcomm CEO, who we heard from last hour, about the delays, about the cost to ship some of these things, the idea that we have a disruption that is not going away, how long this will last, and what that means in terms of output and, frankly, prices for some of these cars. Today, I know that you guys are following this very closely. Bitcoin is becoming a legal tender in El Salvador. I will read the quote again precisely. Not sexy but dangerous, but sexy but untested and complicated. This according to a Stifel analyst in terms of what this means. I find it interesting because
your quote was better.
I know. That's,
I'll give you that.
I mean, it summarized the whole feeling, and the IMF said that it was potentially very risky. So I was just kind of putting them two together and being pretty straight. But to me, I find this interesting because the remittances is the big issue for El Salvador. People who work in the U.S. trying to send money home. How do you deal with the fact that it is costly and time-consuming to go through banks? You go through Bitcoin. It highlights the need for some sort of international mechanism of trade and of transmission of capital. And then at 4 p.m., President Biden is planning to speak on storm damage in New York and New Jersey. Interesting to see how he pushes forward, especially after the disappointing jobs report on Friday, how he talks about the enhanced unemployment benefits that rolled off this week, the idea that they rolled off at a time of weakening growth, albeit still very strong, John. But how much is he going to try to pitch the need for the $3.5 trillion reconciliation bill, even as the likes of Joe Manchin really push back?
Lisa, thank you. Luke Cower of UBS asking the important questions this morning. Who had the worst summer, equity bears or the New York Mets? We can ask Luke that right now. UBS asset management, asset allocation strategist and former Bloomberg cross-asset reporter. Luke, who had the worst summer, equity bears or the New York Mets?
Both often victims of seasonality around this time, but equity bulls managed to overcome some of that negative seasonality, whereas New York Mets fans kind of succumbed to it, I would say.
Look, that's a good answer. I'll give you that, a professional one as well. Walk me through why you remain committed to this cyclical story in this equity market.
So there's a lot of reasons, and one I think is why and how efficiently kind of the market was able to price this kind of deceleration and peak in the second derivative in growth, and the kind of the nature of it being Asia-centric to a large extent. So what we see going forward is, although we have had the peak in growth, the top rate in growth is behind us, for two of the world's largest economies, the U.S. and China, it's very likely, if not probable, that growth actually accelerates in Q4 from Q3 as both as Delta becomes less of an issue for mobility, and in China as some of the measures to kind of support growth do start to kick in or become more visible and evident at the time. So I think that's a key part of the story. And the other part is that you're going to, we hope and think, start to get some more cross-asset corroboration for the cyclical story, and that coming in the form of yields. I think you've seen that recently, really with Europe starting to drive more of the move, and U.S. 10-year yields look to have durably bottomed. So that in and of itself, it does help to lend a little more support towards cyclical assets just based on the correlations. And I think the final thing is that as we look ahead to not just this year, but next year, we're so conditioned in markets to have looked at any period of above trend growth as a very fleeting, almost by necessity, before we get dragged down to something resembling trend. I don't think that investors have fully acknowledged that the next 2 years of growth are going to be essentially better than anything we got since 2010, and in the case of next year, probably better even than 2010 as well.
Luke, there's a lot in there. I want to pick up on the story of China and the U.S., especially following the export and import data out of China that reached record levels. The idea that they're continuing to export much more than people are expecting, even though there has been the Delta variant slowing growth in certain places. It's being interpreted by some as just simply companies and factories stockpiling inventory ahead of the winter season. What's your interpretation that perhaps gives you faith in this growth story?
Well, first of all, that's something that needs to happen, and that's something we've been banging the table about for a while. The fact that companies said they told us they would use any soft patch in demand seasonally to rebuild inventory. So the fact that that's happened is is not surprising to us. It's something that we'd expect. In terms of the forward growth story and whether this demand is kind of transient and just inventory building, I'd note that even if you look at the quote unquote disappointing, which it was, U.S. non-farm payrolls report, even in there you've got the nation's aggregate paycheck growing by almost 10% per year. So absent all of the transfers you've gotten over the past, call it 18 months, still an incredible amount of growth that would leave you as the U.S. consumer essentially in line with the trend line of what would have happened if you just extrapolated the pre-pandemic pace. So still a lot of dry fuel there for consumption, and still a lot of fundamental improvement in the labor market that I would suggest does make you believe that you can believe this story will last for a lot longer. But I will concede that one thing we are paying very close attention to, if you had two charts that would really define and describe the year, would be just how much forward EPS keeps getting revised up and how much EPS continues to surprise during earnings season. One thing that does bear monitoring right now is during the Q3 earnings season, during the Q3 earnings time, if you're kind of just starting at the start of every quarter and then seeing how much global earnings are getting revised up by this point in the quarter, this is the slowest since Q4 2020, which was also the time that the spread of the pandemic was once again weighing on activity. But the key word is revised up, and that continues to be what underpins the equity market. It has a lot of fundamental grounding, even in a quote-unquote broken economy.
They're getting revised up, Luke, but we've had many conversations this morning about the ongoing supply chain issues and some of those inflationary pressures that have proven to this point quite persistent. That means higher input costs for companies. What gives you faith that they're going to be able to continue to pass those costs on and retain margin?
I do think that's another good question. That is a big threat to the market, and you've seen in some cases in some markets versus others, and markets with higher inflation have been the ones that are more able to sustain margin, and therefore they're the ones that you suspect that might come under stress next, because other markets have already faced a certain degree of margin pressure or inability to sustain margin. So I would say if you're worried about margin pressure going forward, that probably augurs for taking a stance of ex-US equities over US equities, based on the fact that that would be where you would expect margin pressures, not only margin pressures, but also some of the tax issues that you alluded to in talking with John and Lisa earlier as kind of more negative factors going forward.
Luke, Tom's not here. If you want a passing dig at the Red Sox, now's your moment, just before you go.
No, can't shoot a man when he's down.
Fair enough. I mean, that's a dig in and of itself, isn't it?
Fantastic.
Luke, thank you, sir. As always, Luke Cow there of UBS Asset Management. Look, on the news of the tax hikes, and Kelly, you touched on it, so let's go to the news from Punchbowl this morning. Democrats appear to back a corporate rate boost to 25%, so a move from 21 to 25. Instead of, Kelly, the move that the president had pushed for, a move from 21 to 28.
Yeah, so we're talking a difference here of about 3 percentage points, but that is still a hike, John. And it's not just corporate tax rate hikes that we are talking about. We're also potentially looking at, of course, a higher capital gains tax rate. We got news on Friday that Democrats are considering other forms of taxes, including on the salaries of corporate executives for excess pay. So there's still a lot on the table here as we look at this $3.5 trillion budget reconciliation and the pay for being written. We have to pay attention to the composition of that, John.
Lisa, as a part of a $3.5 trillion package, but a big effort down in Washington still.
The $3.5 trillion package, is that really going to be $3.5 trillion when you get this kind of pushback? So if you don't get the full $3.5 trillion, but you also get the offsets, then how much growth do we really get from this?
I'll go with lower, if that helps. Doesn't help, does it? Okay. Lisa Bravers, Kelly Lyons, Jonathan Ferro. There we go.
Value
On Bloomberg Surveillance, the state of the obvious. In the equity market, we are unchanged on the S&P 500. Yields are higher by 4 basis points on 10s at 136.64. That was my best Tom Keane impression.
I know, I was just about to say that was really filling in John's role.
I'll do the voice a little bit later if you want.
Thank
From
you.
New York City, on radio, on TV, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. There was an unexpected jump in the exports from China last month. Exports rose almost 26% in dollar terms from a year ago to a record $294 billion. Global demand remained resilient, especially from the US and Europe. It's likely that retailers brought forward their Christmas shopping. British Prime Minister Boris Johnson will risk a major fight with his own Conservative Party today. He's announcing his long-awaited plan to reform social care, and to pay for it, the government is likely to confirm plans to go ahead with a $14 billion tax increase. That's despite pledging not to do so in the Conservatives' election manifesto. In Germany, the national election is less than 3 weeks away, and a new poll shows that support for Chancellor Angela Merkel's Conservative bloc has fallen to a record low of 19%. Merkel's alliance now trails the Social Democrats by 6 percentage points. She is leaving office, and today in the Bundestag endorsed Armin Laschet, her bloc's candidate, to succeed her. And U.S. Attorney General Merrick Garland is promising to protect women in Texas seeking an abortion. The Justice Department is looking at ways to challenge the state's new law on abortion, one of the most restrictive in the nation. The Supreme Court declined to block the law, which bans abortion as early as 6 weeks into a pregnancy. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
predict the Taliban will do in the coming months and years?
I would say consolidation of their power and gaining international legitimacy and recognition. This is the priority for the Taliban, not supporting transnational jihad, not basically in any activities outside of Afghanistan. If you really watch carefully what the Taliban have done in the past few days, they are engaged in a public relations offensive. They are trying to convince the world. I mean, if you listen carefully to what they're saying, you think that the Taliban are newly born Democrats. They are peacemakers. And the reason why they want to consolidate their power, they want to convince the world that the Taliban have changed.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Look, Senator Manchin is a valued partner. We're going to continue to work with him, but we're also going to continue to push our agenda. But it's not abnormal for this to happen in the legislative process, and we're still full steam ahead on trying to get our legislation passed.
Full steam ahead. That was Cedric Richmond there, the senior presidential advisor on ABC over the weekend. From New York City this morning, good morning. Alongside Lisa Abramowitz and Kenny Lyons, I'm Jonathan Ferro in your equity market. We are totally unchanged on the S&P 500, slightly negative on the NASDAQ. The tone really been set by the bond market. Yields higher by 4 or 5 basis points here at 136.81. Yields up, curve steeper. Lisa, would you draw a line between the bond market and what's happening in the NASDAQ right now? Just a softer tone on the NASDAQ 100.
Definitely that could be a piece of it. The other piece of it potentially could be what was reported at a punch bowl, because you could see a slight correlation. I don't want to make too much into basis point moves here, but the idea of higher corporate taxes hitting the big tech world much more than other companies.
Punch bowl reporting this morning that the Democrats appear to support raising the corporate tax rate to 25% as part of their $3.5 trillion package. Let's have that conversation right now with Joe Matthew, Bloomberg Washington correspondent and host of Sound On Bloomberg Radio. Joe, let's start there. 25, not 28. It's widely known already.
And it could change about 10 more times, Jonathan. Thanks. It's great to be on with you. I just am struck by the preliminary nature of this whole thing still. Committees aren't really going to get to work for real until later this week in the House and next week in the Senate. But sure, we'll go with 25% if that brings people to the table here, remembering that we were talking last week about taxing potentially stock buybacks and even unrealized capital gains with regard to some of the wealthiest Americans. So Democrats, if they don't get a higher number here than what they need, they will find other ways to generate more money. $3.5 trillion is a lot to come up with right now, and we still aren't even sure exactly what it's all going to be spent on.
Joe, you know how this works these days. When we say Democrats, we're often talking about one Democrat, Senator Joe Manchin. Can you talk to us about him now? Just, is there a red line there or not? Is this the open of some negotiations for him? What is it?
The most powerful man in Washington, some think, or at least the most talked about. He's not alone, by the way. Kyrsten Sinema, the moderate Democrat senator from Arizona, has been saying essentially the same thing. $3.5 trillion, too rich for my blood. But as you heard there from Cedric Richmond, we heard as well from Ron Klain, the chief of staff of the White House. They believe that Joe Manchin is pliable. There's some leverage here. It's called the bipartisan infrastructure deal. Remember, Joe Manchin was one of the 10 senators who helped to craft this thing. He came up with the deal. Nancy Pelosi, now you know why maybe, is not touching that until reconciliation comes through the House. So we're going to have a big old collision of things, a lot of deadlines hitting at the end of this month. But the fact is, If Joe Manchin doesn't vote for that reconciliation bill, he doesn't get the bipartisan infrastructure victory that he's already been taking a bit of a victory lap on. He wants to go home and say, I got your roads, bridges, broadband, some of the other things that are badly needed specifically in West Virginia.
Sure, and on Friday, Labor Secretary Marty Walsh, when he was on with Joe here, with John Farrow here, I called you Joe, and Joe as well, but just basically saying something similar, that there was this flexibility, or it didn't seem to, it was necessarily a hard line. I do wonder, though, if the mood is changing in Washington in terms of the ability to pass through any kind of stimulus. And I think about how it's not even a discussion to extend enhanced unemployment benefits right now, even though some people are saying we're heading into a weakening patch.
You just put your finger on what I think is the most underreported story of the day here, of the week. This should be on the front page of every newspaper in the country or every news site right now. 10 million people, 7.5 million people losing full-on benefits, 3 million people losing that $300 enhanced weekly benefit. This is going to have an impact. You see this downgrade on the forecast from Goldman. This is the stuff people are worried about. It will possibly send some people back to work, but it will also potentially ding spending. You know, there's the political side of this, there's the human side of this. When I got to work this morning, guys, I parked in front of a homeless encampment across the street where people have pitched tents to live in. There are worries that these are going to become more common, that story and the wealth gap in this country is going to become more common, just as they're debating raising taxes and spending $3.5 trillion.
But does the part of the equation that is the spending part, that $3.5 trillion, become easier to swallow with unemployment benefits, additional ones rolling off, and with the weak payrolls report we got on Friday?
Well, that's what progressives would tell you. You know, they say that we need this now, when in fact they think it's badly overdue. Child care is part of that, by the way, in the reconciliation bill that they say would get people back to work now, after Labor Day. We thought that would be happening, and of course we had that disappointing number on Friday. I spoke with Secretary Walsh after that report. The big question is, will people start going back to work when the benefits expire? And in the states where we've seen that happen, about half the states in the country, there's no evidence, at least according to the Labor Secretary, that has happened. So the other way he likes to ask it, by the way, is $300 enough for you to stay on the couch all day and not go work? For a lot of people, the answer to that is no.
So, Joe, putting aside the politics of the moment and the politics of either spending more or spending less, it seems like there is a definitive response from Washington, D.C., which is less fiscal stimulus, less fiscal support than perhaps previously thought. If we talk about a bigger price tag for this reconciliation bill, we're also talking about bigger pay-fors with respect to higher taxes in a whole host of ways. So does this in itself tell people what they need to know in terms of the willingness to support or add fiscal support to this economy?
Well, potentially, but just keep in mind that this could really change shape a lot over the next couple of weeks. Again, this needs to happen by the end of the month if Nancy Pelosi sticks with her deadline, and these are all self-imposed deadlines, so that could move. But the question about stimulus versus spending, in this case on infrastructure, is a very real one when we're worried about inflation right now, and we have no idea what exactly is going on in the labor market. There's just an enormous amount of confusion, which makes it difficult for the White House and for congressional Democrats, the leadership, to really answer a lot of these questions.
What is a deadline if it's self-imposed, Joe? I share that feeling. Joe Matthew down in D.C., our Washington correspondent and host of Sound On Bloomberg Radio tonight at 5 p.m. Looking forward to that, Joe. Thank you. Let's go to that Goldman call that Joe mentioned, Lisa. Here's the quote. The hurdle for strong consumption growth going forward appears to be much higher. The Delta variant is already weighing on Q3 growth, and fading fiscal stimulus, that's the key line there, fading fiscal stimulus and a slow service sector recovery will both be headwinds in the medium term.
There are some preliminary studies of states that ended their enhanced unemployment benefits early. A number of them haven't, a number of them already have. And it showed that not only was there there was not a material uptick in people entering the workforce, but that there was a material reduction in consumption. People spent less when they had less money coming in. People spent less when they didn't know whether that was going to continue. And to me, that is what I think a lot of people are worried about in the administration. But the fact that they cannot get any traction in an extension or even having that discussion because it's politically toxic tells you a lot.
So Goldman go to 5.7 from 6, Lisa. Do you know what was interesting about it? No one talked about 22. Kaylee, Goldman go to 4.6 from 4.5 to 22. 4.6 is in the Luke Cower camp. That this growth is going to be decent. It's going to be decent for a few more years.
Yeah, it's this idea that I've heard you mention so often in the last couple of weeks, John, not necessarily growth being lost, but growth just being deferred, growth being extended out now into 2022 instead of us seeing the bulk of it in the third and fourth quarter. The idea that maybe the Delta variant impact is transitory and the uptick in consumption may be pushed on into next year.
Delayed and not derailed is something you'll find in a lot of Southside research report of the equity bulls, no doubt, into year end. From New York this morning, we're going to catch up with Jim Sullivan at TD Securities next. The man who was looking for 400K, that was the lowest estimate for payrolls Friday, and the closest anyone came to the number itself. From New York, this is Bloomberg. Let's get the session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report. The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance. And the next 90 seconds or so will be totally uninterrupted because Tom Keen's away for the next couple of days. I'm going to enjoy this one. Equity futures this morning on the S&P 500 totally unchanged to positive, almost 0.1%. On the Nasdaq, we're unchanged there as well. On the Russell, we advanced almost 0.1%, in and around a move higher by almost 0.1%. For the equity market, you know the story, we've talked about it through the last couple of hours. We're already downgrading the month of September, the importance of the month of September, and we're doing that on September 7th. This was meant to be the month the supply constraints started to heal. Are they going to? Are they going to this year? Never mind September. We're now talking about 22 and maybe 23. So what do you do in an environment where inflation could persist, higher than expected inflation could persist, and growth starts to decelerate? That's something we need to get our hands around, particularly what does it mean for the bond market? Switch out the board and get to the Treasury market. 2s, 10s and 30s shaping up as follows. Yields higher Friday, curve steeper. Doing it again Tuesday. Yields higher this morning by 4 basis points to 136.64 on 10s. On 30s to 198.12 at 4 basis points. And what does that all equal? It equals a steeper curve. Finish on this, finish on the chart of 2s, 10s. We topped out at 157 on March 31st. Right now we trade at 115.63 on 10s. Yields higher, curves steeper, and that gap between 2s and 10s starting to spread a little wider as well. What does that mean for this market? Remain Bostic, I imagine for the banks. Remain, that's what the banks want to see.
Yeah, I mean, it'll be interesting to see how that shakes out. We saw that weakness last week in some of those banks. As for what's moving this morning here, your biggest mover, at least in terms of the large cap names, that actually belongs to Match Group. Those shares up about 13% here, about 12% right now here in the pre-market. Of course, we got the announcement late Friday that it would be added to the S&P 500 along with Ceridian and Brown & Brown. So a few folks trying to front run that inclusion, which takes effect in about 2 weeks' time on September 20th here. Also moving today is Spotify, an interesting upgrade today. This over a key bank, and he talks a lot about how the company now actually outpacing YouTube Premium. You're seeing those shares up about 4% here on the day, and Alcoa moving higher as well. Keep an eye on aluminum prices, 27.82. That was your high on the London Metal Exchange earlier today. That's a 10-year high. Of course, that coup in Guinea, of course, a key supplier of bauxite, causing a lot of concerns. President Alpha Conde out, the Constitution suspended. Rusal, the big Russian miner, has said that it may actually evacuate its staff there, so a lot of concerns about what this could mean for alumina prices going forward. Flip up the board. Matthew Harrison over at Morgan Stanley doing a bunch of downgrades here in the healthcare space. J&J being cut to neutral effectively right now. Vertex actually going all the way down to underweight here on some concerns here about the long-term catalyst, and I guess some concerns as well about exclusivity. And I want to point out the second line of the screen here for our television audience, IronNet. These shares up about 112% here in the pre-market. This is your latest meme stock, folks, guys. This stock actually rallied about 32% last week and about 30% the week prior to that. This is actually the cybersecurity company that was founded by the U.S. General Keith Alexander. It went public via a SPAC last month, and for reasons unknown, a lot of the retail traders have really gravitated to this stock right now. There's no real fundamentals here. This is a stock where analysts expect revenue for the year at about $29 million, shares up 112%.
A $1.4 billion market cap. Remain, I love that, for reasons unknown.
Reasons unknown.
Rinse and repeat. Rinse and repeat. Remain Bostic. It's good to catch up. We'll see you on the close a little bit later this afternoon on Bloomberg Television alongside the rest of the team. For this market on Friday, it was all about the estimates. The range, Elisa, was wide, wide, wide. The low end 400K, the top end 1 million. The median was something in and around 700K. And we got, what did we get, 235. Do we call 400K, that low estimate, the best estimate or the least worst?
I would say it's the best.
What are we calling that?
I would say it's the best estimate because it went against consensus that we were going to see sustained growth. However, John, and this I think really goes to your question, how much are we looking at the actual headline number? How much are we looking at the revisions and the 3-month average, as you mentioned, which still show a pretty decent picture?
You call it the best because the guy who made it's coming up next is Jim O'Sullivan, TD
yes.
Securities Chief
Absolutely.
US Macro Strategist. Jim, Lisa calls it the best. I'll go with the least worst. 400K. Jim, what did you see that others didn't, and do you think it will persist?
Well, yeah, I'd say it's the least worst as well. And our goal is to be the least worst. In terms of leading up to it, I would say the daily home-based numbers in particular have been on the weak side. And certainly that was consistent with pretty sharp slowing in the leisure and hospitality category in particular, which has been up almost 400,000 in each of the previous 2 months. So I mean, it does look like that sector slowed pretty sharply. I mean, there was a lot of question and debate about employment in state and local government. Certainly the start of the new school year is a bit of a wild card, and that's going to be an issue next month for September again. But certainly the weight of evidence was that there had been significant slowing. Now, 400,000 estimate, even 235, of course, by pre-COVID standards would be pretty strong. But I mean, it does look like the days of 900,000 plus are gone.
Jim, you know what the equity bulls did as soon as those numbers came out? They said this is a blip you can look through. From your standpoint, your perspective, is this something we can look through, or the beginning of something we need to pay attention to?
Well, I mean, it was unrealistic probably to expect that we're going to get 900,000, a million per month for an extended period. So I think there is clearly a downshift here. Now, that said, monthly numbers do jump around a lot. There's a lot of challenge with seasonal adjustment. There's even a bit of a tendency for the August numbers to be revised up later. I mean, that said, I mean, do we see anything in the last couple of weeks to suggest at this point that September is going to be a lot better? No. I mean, we are assuming in our forecast that, like, on an extended basis for the next 6 months, we're more like 400,000 a month or thereabouts, 4 to 5, better than 235. But at this point, I can't say there's any hard evidence that September is going to be better.
So does that support this idea of a slower slowdown or a more sustained slowdown than perhaps people had been expecting? Are you also downgrading your full year GDP forecasts?
Well, it's not just the payroll numbers that have been a bit weaker. Certainly the numbers that directly go into GDP have been on the softer side as well. Consumer spending in particular has slowed down since March. I mean, certainly retail sales surged in March when you had the last stimulus payment, and they've kind of flattened out, even declined a little bit since then. Now, there's some supply issues for sure with autos, but it does look like the boost from fiscal stimulus has peaked. So we have been counting on slowing going forward, but it looked like third quarter slowed a bit faster than we thought. So we did just mark down our Q3 number to 4% from 7%. Now, we still have 4% for the fourth quarter, this is GDP, but that does result in 2021 being cut to 5.2% on a Q4 to Q4 basis from 6%. So yes, we have cut our 2021 numbers. And again, I think part of this is clearly Delta and the COVID wave. I think that's part of what's going on, but part of it is the inevitable fading of fiscal stimulus. And fiscal stimulus is poised to fade to the point of policy being contractionary on a change basis in 2022.
Although there is this question of a record number of job openings, and we'll get another read on that tomorrow with the JOLT stat of the job openings figures. Why are we not seeing more people enter the labor force, especially as we get the roll-off of these enhanced jobless benefits? I don't understand, and I think that a lot of people are asking, what if there's something else going on and they're being replaced by technology, or companies are finding other solutions?
Well, I mean, that's the big question, of course, and there's been a lot of debate, and it's been a political debate, of course, over how much of the weakness on the supply side, the net drop of the participation rate, has been because of overly generous unemployment benefits. And I mean, we certainly think that's been a factor. I think COVID is still a factor. A lot of people don't want to go back to work because of COVID. And COVID has caused issues with getting childcare. And in addition, there was a lot of stimulus. I think a lot of people are not as in need of a job immediately because of all the accumulated savings from the stimulus as well. Now, that doesn't apply to everyone, of course, but there have been a number of factors. And I mean, as you say, the unemployment benefits are expiring this week. I mean, some states already saw them expire. Been a lot of talk about how it's not clear that even in those states where the benefits already expired, that there was a sudden surge in supply of labor, but it's hard to really disentangle that from all the other effects. I mean, we do expect as time goes on, the supply side will come on more and more. We don't think the participation rate is going to stay as low as it is right now. And meanwhile, on the demand side, we do think things are starting to cool a bit. So, I mean, some of these imbalances, I think, will resolve over time. But yes, there is still strong demand for labor, and that would argue that we should continue to get reasonably strong employment numbers going forward.
So put it all together, Jim, and how different is the equation for the Fed this morning than it was at this time on Friday?
I think it certainly keeps the debate going. I mean, our view is, I mean, of course, their signal has been that the taper is going to come this year. And of course, there are 3 meetings left this year. Now, our interpretation of that has been it's not September. Just the wording has not been urgent enough that it's been either November or December. I think that's still the case. Our view has been December. I think to the extent you're getting weaker numbers here, including payrolls, including the downgraded Q3 GDP numbers, I think that helps the case for holding off a bit more till December. And obviously, we'll get another employment report before the November meeting. But we think that it doesn't stop them from tapering. I mean, obviously, if the economy was truly collapsing and you were seeing zero growth, that's a different story. But if you're getting kind of 4% type GDP growth and unemployment is still coming down, you look at numbers like the ISM indexes, they're still around 60, jobless claims are falling. I think there's enough improvement, substantial improvement, for them to move ahead with tapering. Now, the tightening question, the rate hike question, of course, is completely different.
Yeah.
And to the extent momentum is down in 2022, I think that would argue for being patient once tapering does conclude in late 22, presumably, that they're going to sit back for a while before they actually raise rates.
Hey, Jim, good to catch up. As always, Jim Sullivan there, TD Securities Chief, US macro strategist. Some news coming out of the UK in the House of Parliament. Prime Minister Boris Johnson announcing a health and social care levy of 1.25% of incomes to help pay for post-COVID NHS catch-up operations. Says he'll raise the dividend tax to help fund healthcare as well. Lisa, this has been quite controversial in the lead-up to all of this. Not the funding of the NHS, of course. That's the least controversial aspect of any of this, just to state the obvious. More about how this will be funded and who's going to pay this tax. The Prime Minister going on to say the new levy will share the cost between business and individuals.
Yeah, and this ultimately does come down to who ends up bearing the brunt of this. Over in the U.S., people focusing more on corporations, but you're also seeing the capital gains taxes. Just want to point out the pound is sort of at a session low here versus the dollar, so it seems to be affecting 137.89 here.
The Prime Minister Boris Johnson addressing Parliament from New York City this morning. Good morning to you all. In the next hour, Megan Green of the Harvard Kennedy School alongside Lisa Bravitz and Katie Lyons. I'm Jonathan Ferro. Your equity market basically unchanged on the S&P. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden needs Democrats in Congress to give him a boost by passing his $4 trillion economic agenda, but divisions in the party threaten the chances of that happening soon. Democratic progressives and moderates are at odds over the size of the tax and spending package. Meanwhile, there's a battle coming up with Republicans over raising the debt limit. It's one of the most contentious issues of Brexit. The UK's extended post-Brexit grace periods for trade between Great Britain and Northern Ireland. British officials want the EU to rewrite a part of the Brexit deal that effectively keeps Northern Ireland in the bloc's customs area. And aluminum traded near the highest since 2011 following a military coup in Guinea. The West African nation is a major producer of bauxite, which is a key ingredient in the metal. China imports more than half its bauxite from Guinea. The leader of the coup called for continuity of production in mining. He also said existing mine agreements will be honored. Morgan Stanley is bringing its program to hire more black and female traders and salespeople to London. The firm is hoped to replicate the success it's had over on Wall Street. The Morgan Stanley program is aimed at recruiting black or female candidates already working in other industries. It's received more than 800 applications in the U.S. In the last year, the bank has hired 70 people across its business. And Bitcoin faces the biggest test yet in its 12-year history. El Salvador is becoming the first country to adopt it as legal tender. The country bought 400 Bitcoins ahead of the rollout, worth about $20 million. The question is whether a significant number of people want to do business with Bitcoin when it circulates alongside the US dollar. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Somebody said, I want to be the next Reid Hoffman What would you say is the best training ground to do that?
Well, I'm still young enough that I'm still hoping to be the next Reid Hoffman myself.
Are you still committed to the U.S. pickup market? You mentioned how small it is, and I know you do good business at the frontier, but a lot of times Americans want something bigger like the Titan. Is that, do you plan to stay in that market as competitive as it is?
I mean, for us, market is one thing. The second is what customer aspires for from Nissan. And customer in United States aspire for sedans, SUVs, and the pickups. And Titan is a great pickup truck, and we are, of course, focusing on the Titan. But as I said before, that in our whole lineup, our main focus is always been in the sedans and SUVs and the smaller pickup truck.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There is wide disagreement on whether we've seen the worst of the Delta variant in terms of the upsurge in cases. Where do you fall on that?
So I see that the curve is continuing to go up, which is worrying. What is making me really nervous today is that there is this accompanying surge in deaths as well.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're very fortunate to have a relationship with China that may be a model of what stability look like. We participate in growth in advanced technology. The China respect intellectual property of Qualcomm, our patents are licensed to a lot of Chinese companies, and we're generating growth for us and for our Chinese partners, and we expect that to continue.
Cristiano Amon there of Qualcomm, the CEO. Lisa, I'm smiling. Just listen to some of that. China respects the IP of Qualcomm. We're fortunate to have a relationship with China. That is a PR response from the CEO of Qualcomm this morning with Matt Miller.
Dancing delicately at a time when
clearly.
the Chinese authorities are cracking down more than they have in decades, possibly, when it comes to both social as well as business interests. So, John, I understand why.
We'll move on from there quickly.
Will we?
In the equity market. No, we'll be back to it in about a minute.
Exactly.
On the S&P 500, up almost 1/10% on the S&P. Yields are higher by 4 or 5 basis points. 136.81 is where we are on 10s. The 2 years anchored. So this curve is steeper, and it's not just a US-centric move either. You see it in the bond market in Europe. You're seeing it in the BTP market over in Italy. All of that ahead of the ECB meeting. A little bit later this week, that news conference taking place on Thursday. Full coverage of the decision, the news conference with President Lagarde right here on Bloomberg Radio and on TV. Let's turn to our stocks editor, Dave Wilson, on this equity market. Dave, 7 months of gains on the S&P 500 into September. What do the market historians tell us?
Well, I mean, the data kind of says we could be anywhere at the end of the year, and it's specifically the first 8 months for the S&P 500 being up more than 20% as it was this year. You've seen it happen 10 other times, and it really is kind of a split, a pretty substantial split, in terms of gains and losses. Look at it this way. If you take all the numbers and add them up and divide them, you end up with a loss of a bit more than 2%. But if you take the median, kind of do that statistical analysis, you end up with a gain of a bit more than 2%. So, it really kind of leaves you wondering where we're headed from here if you're just looking at periods like we had in January through August. I suppose if you wanted to kind of look at a deciding factor here, it may just be that, we have been rising so steadily this year. 54 records already. It's one of the best years in terms of the number of all-time highs for the S&P 500, and it's on pace to be the best ever. That said, we haven't had a 5% retreat from a high, a pullback, drawdown, call it what you will, all year. And, you really don't see a whole lot of years where that's the case. In fact, I was looking at some numbers that Truist Securities compiled. Keith Lerner, their strategist over there, and he pointed out there's only been twice, 1995 and 2017, where you saw the S&P 500 not pull back 5% during the year.
Hey, Dave, thank you. Looking forward to catching up with Tony Tuan on this story a little bit later. Dave Wilson there, our stocks editor. A dream for Lisa, this conversation when 1987 comes up and 1929 as well, Lisa, after 20% gains. What happens after 20% gains through August? 1929 down 32%, 87 down 25. Any comment?
I get it. You're trying to bait me. You're like, all right, the gloom master is going to come here and basically say, look, yeah, we're going to have this massive crash. I think that, honestly, Adam Tooze was a phenomenal guest earlier in the show, the Columbia University professor. The game has changed. And the question now is, what is going to be the policy response? And this comes to monetary policy, and it comes to also fiscal policy, John.
There we go. The game has changed. Maybe that was a little bit too extreme. Maybe you prefer this one from George Soros this morning. Making some headlines in an op-ed in the Wall Street Journal.
Punchy.
Pouring billions of dollars into China now is a tragic mistake. It is likely to lose money for BlackRock's clients, and more importantly, will damage the national security interest of the U.S. and other democracies. Damien Sassar of Bloomberg Intelligence joins us now for more on this. Damien, your take on the George Soros op-ed, which I have to say is also the most read story on the terminal this morning too.
Well, of course. I mean, we're using some very big terms here, calling Xi the most dangerous enemy to open societies in the world. That's George Soros, former hedge fund manager, broke the Bank of England. But look, a lot of his concerns have been voiced already. They're concerns that are shared by many. Look, I'm going to quote something from Ted Lasso. I'm actually going to quote pull a feather out of Roy Kent's hat. It's difficult to know what's going on in the pitch when you're not in the locker room. So for me, I don't think BlackRock's recommending investors pour billions blindly into China. What I think they're pointing out is there's an obvious valuation discount given the regulatory overhang in Chinese equities. And more importantly, China rates with, real yields in the U.S. and Europe, low, negative, forever. You got to get your yield somewhere. And China with 10-year at 285 right now, may offer some of that and some reprieve for institutional investors globally. So I think that's probably something BlackRock's looking at.
All right, George Soros is a polarizing character, and he used some pretty lightning bolt types of words. But if we take a step back, there is this question of the reputational damage of international investors going into China at a time when arguably they are embarking on something that feels a little bit like, I don't want to say cultural revolution, but that is akin to that type of overall kind of control by the top. How much do you see that potentially affecting flows into China going forward in the next couple of years?
I agree with you, Lisa, but this is about diversification, right? This is about, diversifying portfolios. I mean, we could talk about Markowitz 101 all we want. But look, I don't think, we're sitting here blindly saying, invest in Chinese equities, invest in Chinese assets. No, this is saying that investors globally have been underweight to China, and it's one of the largest, if not going to be the largest economy globally. And so investors need to have exposure there. Look, as an emerging market investor, you take what the market gives you. And when, valuations decline as rapidly as they have in China, that's typically a good time in emerging markets to be taking advantage of that.
Well, one of the sectors that has been embroiled in this crackdown is the property sector. And Bank of America put out a note overnight saying that if China doesn't stop acting so aggressively and inflicting the kind of pain that has been seen on Evergrande elsewhere, it's going to spread too far. And that is actually going to undermine the China growth story. How large is that risk?
Well, there was another China economist, a prominent economist, who came out and backed that up and said, imagine if values actually fall below the mortgages that Chinese households have on their homes. I mean, that would be pretty bad, Kaylee. So I completely agree with you. And look, CCIC, which is the big rating agency in China, downgraded Evergrande, the largest property manager in the most indebted property manager in the world, $37 billion of liabilities outstanding due in the next 12 months. I mean, that's just crazy. They downgraded them to junk at the end of last week. So look, there is more pain ahead in the property sector. I can assure you of that. And that might, resonate through in the Chinese economy, but is bullish for Chinese government bonds, right? Because it implies that the PBOC is going to have to cut rates in order to stimulate growth.
Damien, good final point there, sir. Thank you. Damien Sasser of Bloomberg Intelligence. Always good to catch up, Damien. Thank you very much. Evergrande's debt, Lisa. The dollar bond due 2025, 25 cents on the dollar. High-yield notes in China, north of 12%. Started to talk about the contagion risk over the last couple of months, quite clearly bleeding through credit in China at the moment.
And frankly, the fact that policymakers have not stepped in earlier highlights how they really are taking a different approach. It's kind of the question you were asking, Adam, too, is about how they've taken a much more hands-off approach to this whole crisis and allowing defaults as they try to transition to a new regime. The U.S., a completely different story. And frankly, you do wonder if they allow contagion to continue.
Kelly, you asked the question, have they taken it too far? I think some people might say we're already there. Growth risk is pretty clear.
Yeah, the question is on the regulatory side, if China does extend the crackdown, is it going to be made up for by looser monetary and fiscal policy? That is the question, John.
Kelly Lyons, Lisa Abramowitz, Jonathan Ferro. This is Bloomberg Surveillance, your equity market. Futures up almost 0.1%. No drama as we get back to work on Wall Street. On radio, seen on TV, this is Bloomberg Surveillance.
China has been focused for a long time now on catching up to the United States in space when it comes to space exploration, and they've really made a couple of really impressive achievements. For instance, in May, China landed a rover on the surface of Mars. It's only the second country after the United States to manage to do that. In June, China sent astronauts to its space station, which is still under construction. China is not part of the International Space Station because the United States worked to exclude China from that. But instead, the Chinese are working on their own. That's scheduled to be in full operation, I think, next year. The Chinese have really come a long way in space. That said, all of that's run by the Chinese government. There is a role for Chinese companies to play in the space program. They're not being as front and center, say, as Elon Musk with SpaceX or Jeff Bezos with Blue Origin. China's companies are playing a more supportive role, I think it would be a fair way to say it, working on things like satellites, rocket launch operations. They're leaving the really big, sexier items when it comes to space exploration, leaving those to the Chinese government.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
markets love this period of time potentially where earnings growth is good.
The curve has flattened significantly. It's almost the market saying the Fed is exiting no matter what.
It's not so surprising that momentum is slowed. It's just surprising that it's all been lumped into this quarter.
The most important thing not to lose sight of here is the emphasis that tapering is not tightening.
The really harsh lesson that this crisis taught us is that printing the checks is really the easiest part of this.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Yields are higher, the curve is steeper. From New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowitz and Katie Lyons, I'm Jonathan Ferro. Tom Keene back with us in a couple of days. It's a snooze in the equity market. A snooze fest on the S&P 500, unchanged on the S&P. Similar move on the NASDAQ. Likewise on the Dow. That's for you, Tom. We're unchanged on the Dow as well. Almost positive 1/10%. I know Tom's watching. That's just a nod to TK.
Yeah.
In the bond market, Lisa, that's where the headlines are. Yields are higher again, and this curve is steeper.
And it's higher perhaps because the Fed has less incentive to begin tapering sooner as a result of that disappointing labor market. Other people saying perhaps it has to do with supply chain disruptions. Other people still saying maybe it has to do with higher wages. The answer, though, to this, John, really will determine the path of the rest of the economy and, frankly, markets, because these outcomes are not the same.
What do you make of the Jim Bianco argument that maybe the window's closing for the Fed, just getting it a little bit smaller to get something done here?
Well, in terms of getting something done, the question is tapering or tightening. Tapering, they're going to do, whether it's December, whether it's January. A lot of people say it's not going to make a big difference. If they end up pushing out how long they end up tapering to the point where we already start to see a turn in the economic cycle, what will be their incentive to actually raise rates at that point? And they've got to start tapering fully before they can raise rates according to their own communications.
That was the conversation after Friday. Katie Lyons, your take on this. Is that the bond market starting to pick up on that conversation a little bit more, that we push out Fed action?
Perhaps, John. I think also we still have to keep in mind that we're looking at a 136 on a U.S. 10-year yield. We're still about 40 basis points south of the highs on that yield that we saw back in March. So the bond market has been sending confusing signals for a while now. But I do think Lisa's point about the wage pressures is an interesting one, because, yes, you had a 4 handle on wage growth in that report we got on Friday. But how much of that is the composition effect, and how much of that is the labor shortage really resulting in the power being shifted to workers instead of employers, and them being able to demand higher wages, and what kind of inflationary pressure is that going to create going forward?
That's the conversation as we kick off this trading week. Stateside in New York City, here's your equity market on the S&P 500, advancing around about 3 points, advancing almost 1/10%. And there's the move in the bond market. Yields higher by 4 basis points on 10s. Similar move on 30s. This curve is steeper. Yields are higher at the long end, the 2 years anchored. 136.47 is where the 10-year is. Euro slightly negative, euro dollar down almost 1/10%. I'm clutching at straws here looking for a move. Euro dollar 118.62.
Doing a great job.
Going into the ECB. Thank you, Lisa. You sound like Tom too. We're sharing the responsibility.
Word. Yeah, well,
I take it back. Your 3-year note coming out a little bit later, some supply at 58 billion. Tomorrow, 10 years at 38. 24 billion of 30-year notes coming up a little bit later. Ton of supply this week, Lisa.
Yeah, this actually will be interesting to see overseas demand. And we talk about yields going up, but their yields are going up over in Europe as well. And I do wonder how much we're going to be tilted toward the ECB's meeting on Thursday as a seminal moment this week, because they're going to be talking about tapering. The fact that they're talking about tapering in tandem with the Federal Reserve, to me, is significant.
Can you do the go to cash impression again?
Go to cash.
That was beautiful. Thank you. Save that one for when he's back on Thursday. I love the impression of anyone that does an impression of Tom Keene. Joe Quinlan joins us now, Maryland Bank of America Private Bank Head of CIO Market Strategy. It sounds a lot like that, doesn't it? Joe, thanks for being with us. Do you go to cash going into this year end after a stellar run so far in 21?
Well, only if we're redistributing, we're looking at redrift, looking at some of the numbers here. But no, I mean, we like cash here. We're building a little bit here because if we do get this pullback, we want to I'll have a shopping list to be ready to go. But we still long-term equities.
Okay, Joe, you have a shopping list. Who among your colleagues does not have a shopping list?
Well, Lisa, you got to be ready to start shopping, not wait for that 5% pullback. Some folks, I'm not going to buy unless it's 10%. When you see good value come into the markets like we saw earlier this year with, say, technology, last year, energy, step in and buy. So a lot of our clients are long-term investors. They've been sitting on the sidelines for the last 18 months, but they're slowly but surely coming back into the markets.
How much show are you watching the economic data if the economic data is somewhat divorced from market fundamentals? The idea here that any weak economic data will just be met with a prolonged tapering or a prolonged tightening by the Federal Reserve.
We're watching that very carefully, particularly as you noted earlier, the wages. The wages are hugely important, and how much can companies offset that with productivity or price gains. So that's going to be hugely important in terms of the kind of the granular effect. And then longer term, we're looking for companies with good productivity, good brands, core competencies. They have a global presence as well. So we still think, with the shopping list, despite the market run, there's good places to put some money to work.
If we were to see a dip that you could then buy, Joe, what would be the catalyst for it? Or are we not going to get a 5% pullback in 2021?
Well, I mean, we'll get it eventually, right, Kayla? We'll get it for sure. There's no doubt about it. But we have a barbell strategy. We like health tech. We like technology. But I still think industrials, financials, certain parts of the energy sector, there's more upside there. So we're going to put our kind of emphasis on the cyclicals first and then go back and look at, say, technology and healthcare.
Are we going to get it because bond yields move higher?
We could say, well, for why would bond yields move higher? Is it related to inflation, stronger than expected growth? What's the dynamic behind that? And we do think that maybe Q3 is going to be a little weaker with real growth, but we're pushing out demand into 22, which means above average growth heading into next year, along with, I think, better than expected earnings expectations. So that's a setup for a grind higher in equities, even from these levels.
Joe, everyone's got a plan. And you know the great philosopher Mike Tyson, many people have quoted him in the past, everyone's got a plan until they get punched in the face. And this is often the case in markets too, that we always sit here and say, yeah, when you get that 5% move, you buy it. But in the context of a decelerating global economy, that 5% move could be confused with something much worse. How do you draw a distinction between the good time of 5% drawdown that you buy and the one in the moment that you should avoid?
Well, John, I mean, we're not market timers. Anyone who tries to time this market, as everyone knows, it's a fool's game. You can't time this market. So be opportunistic on days when there's more red than green. Look at the companies, sectors you want to be in, what's lacking from your portfolio, whether it's fixed income, equities, international. So I think, the plan is to know what you need, know what you have, know what your income aspirations are later on. So really, portfolio construction is really about the longer term, being opportunistic on these down days, but then, not trying to time the market. Just own good quality assets. That's the key.
Joe, let's talk about that relative to the shape of the cycle. And just theoretically speaking, let me describe what it could look like. If we did have higher inflation and that persists and growth continues to decelerate, what do I want to own in that kind of environment?
You want to own technology, automation, robotics. This is, we talk every day about the labor shortage, not realizing the flip side. Automation, artificial intelligence. Restaurants will not have waitresses, right? You go, they don't have menus anymore. So, I mean, we're on the cusp of a technology robotics renaissance that helps drive that, John. So we got higher inflation, higher bond yields. We've got to grind down in the market. Good companies will come out of this stronger, and I think they're going to be the tech-led companies related to robotics, artificial intelligence. That we're still in the early innings in that space.
Joe, just to wrap this all together, we've seen a record amount of equity flows into retail funds, and I wonder what the signal for a professional, for an institutional investor like yourself really is.
Well, I mean, it can be scary, Lisa. Obviously, history suggests we're near a peak. But we're just seeing a lot of excess savings come through to the markets, and we're not done yet. We're very weary. We watch it very carefully. But with households sitting on $2 trillion more in savings, we think there's some more upside to this retail-led move up in the market. But it's justifiable based on earnings. This is where you have to focus on high quality, not to kind of the lower quality equities.
Joe, thank you. Always good to catch up with you, sir. Good to hear from you this morning. Joe Quinlan there of Maryland Bank of America Private Bank, the head of CIO Market Strategy. Katie Lyons, do you have a Mike Tyson story?
I do. Lisa has one too. If you recall, Lisa and I were on the same flight to Greece.
I do recall.
Earlier this summer, and Lisa's travel companion snuck me into the Delta Lounge as a family member. And Mike Tyson was there. And I dared Lisa to go up and take a selfie with him, but she said no.
Yeah,
I don't know what's more interesting about this.
No,
you family members? Family members to get in the lounge?
It was all a ruse. So much to
Did you
this story.
disclose the lounge just then as well? That you conned who?
All I could say is, actually, Mike Tyson was there, and he was getting a lot of people coming over and taking selfies with him, and he was very gracious about it.
And you didn't want to do that?
Yeah, I'm going to leave him alone.
Stay professional.
Lisa doesn't want to get punched in the face.
Thank you, Kaylee. Thank you very much. Look at those markets.
I'll look at those markets just for you, Lisa.
Thank you so much. I
Just for
appreciate it.
You owe me one
I
when
do.
Tom's back, all right? Up 3 on the S&P. We advanced almost 1/10 of 1% on the S&P 500.
Give you an impression of him.
Yields higher by 4 basis points on a 10-year at 136.47. You know exactly what Tom Keene would say. Travel companion. Euro dollar 118.61. Negative 1/10 of 1% on euro dollar. I'm not going to go there. Don't worry. WTI 67.83.
Listen.
We're negative 2%. Listen.
I just want to
tell you something.
comment about the actual conversation we were having
Please do.
about who doesn't have a shopping list, who doesn't have a barbell
It's kind of my
strategy.
question too.
This is the new consensus that basically everyone who wants to get cash wants to deploy it on the dip.
If everyone wants to buy the dip, do you ever get the dip? And that's kindly been the story of the last 10, 11, 12 months, seemingly. Easier said than done. Let me tell you, the people that stuck with it, they did really, really well. Kelly Lyons, Lisa Bramwitz, Jonathan Ferro, and a travel companion out there somewhere. In the equity market, up almost 1/10 of 1% on the S&P. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
With the first good news, I'm Rishka Gupta. British Prime Minister Boris Johnson has called for $50 billion in tax hikes over 3 years to pay for improvements in social care. Both the payroll tax and the tax on dividends would be increased. Johnson acknowledged that the new taxes break the Conservative Party's election manifesto, but he said that a global pandemic was in no one's manifesto. Israel was once a frontrunner to move on from the coronavirus. Now it's one of the biggest pandemic hotspots. According to Johns Hopkins, Israel had the highest per capita caseload of anywhere in the week that ended September 4th. Meanwhile, its world-beating inoculation rate has tumbled down the list of global leaders. Now Israel is focusing on booster shots to protect the vulnerable. In Germany, the national election is less than 3 weeks away now, and a new poll shows that support for Chancellor Angela Merkel's Conservative bloc has fallen to a record low of 19%. Merkel's alliance now trails the Social Democrats by 6 percentage points. She's leaving office, and today in the Bundestag endorsed Armin Laschet, her bloc's candidate, to succeed her. U.S. Attorney General Merrick Garland is promising to protect women in Texas seeking an abortion. The Justice Department is looking at ways to challenge the state's new law on abortion, one of the most restrictive in the nation. The Supreme Court declined to block the law, which bans abortion as early as 6 weeks into a pregnancy. And Deutsche Telekom has agreed to sell its Dutch unit for $6.1 billion. The buyers, Warburg and Apex Partners. It's one of the biggest transactions in the European telecom sector this year. Meanwhile, Deutsche Telekom and SoftBank have announced a share swap plan that will increase the German company's holding in T-Mobile US. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information Insight.
Angela Merkel, after 16 years in power, actually, remains one of the most popular, if not the most popular, German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
If you look through the noise, this is a very strong labor market, good recovery. You know, is there more room to go? Sure. You know, and that's what some of the points many of the more dovish members have been highlighting. And that's, I think, the broader takeaway is that the reopening is happening.
That was the takeaway after the big downside surprise in a payrolls report on Friday. Jeff Rosenberg there of BlackRock. From New York City this morning, good morning. Here's your equity market alongside Lisa Bravitz and Katie Lyons. I'm Jonathan Ferro. Tom Keene back in a couple of days. Your S&P 500 up 2 points, advancing 0.04%. The bigger move, you'll find it in the bond market. Talked about it through much of this morning. Yields higher by 4 basis points on 10s to 136.13. Yields are higher in the curve. It's just a little bit steeper. We have a ton of job openings in the United States of America. Lisa, millions upon millions, north of 10 million. There is a belief that they'll stay open and they'll eventually get filled at some point, maybe later this year and into next year as well. That supply will finally meet that demand. But you raised an important question this morning. What happens if actually the job openings just start to close and not because someone turned up?
And that's actually not my point. It's Peter Shear's point of Academy Securities, who's joining us just shortly. But I will raise this, John, that over the weekend I was in Massachusetts and there was a fish and chip store that was closing early because they could not find sufficient staff to staff the place and then make enough money to turn a profit or even stay afloat. It raises this issue of how much does it put a damper on economic growth that we are not ending some of these frictions that continue in the labor market.
Let's turn to Pete right now. Peter Cheer of Academy Securities, the head of macro strategy, joins us. Pete, let's start there. Is there a risk that demand that we talked about through the year, which has been so robust, we're just sitting here waiting for supply, that demand actually starts to go away?
Yeah, I think this month is really, really critical, right? We've had the reopening, schools should be reopening, people should be ending some of the supplemental stimulus checks. So if we don't start filling those jobs, I'm very nervous that some of those jobs will disappear. Either companies will close, especially smaller companies, or we'll start seeing more and more automation, as your prior guest said, fill in those jobs. So I think this is a really critical 4 to 6 week period where if we don't see those jobs getting filled, there's a real risk that those jobs go away. I'm thinking about it almost like a football match or soccer game or hockey game, where there's been all these easy chances to score, and you're not scoring. You start getting that nasty feeling in the pit of your stomach that, man, if we can't take advantage of this now, this is not going to end well.
Although throughout the whole show, as John mentioned earlier, there is this feeling that September has been deferred, that the Delta variant slowed things down and actually created some kind of fissure in the recovery that will be resolved perhaps in October. Is this 4 to 6 weeks really that critical, or can we just look to October, look to November and December when holiday spending starts and perhaps school gets more up to speed to really gauge whether we see that kind of dynamic that you're talking about?
No, I think we really have to start seeing some progress now, because very quickly the October narrative will switch to, well, it's almost November, it's getting colder, oh, it's holiday season, maybe we don't reopen until January or February now. So I think this next 4 to 6 weeks is critical regardless of where we are with the Delta variant, and we have to either see us push through, fill these jobs, or a lot of my take on the economy starts dissipating, though especially if DC doesn't come through with an infrastructure plan. So maybe that's the offset.
Well, Peter, I'm glad you took us there, because September wasn't supposed to just be a big deal potentially because of the Fed meeting on the 22nd. Also, by the end of this month, in theory, the Biden administration would like to see its economic agenda passed through Congress, $3.5 trillion of spending and some tax hikes that could come with it. Do you think the market has properly priced that into the equation?
No, I actually don't. I think with all that's gone on in the past few weeks, where the Biden administration's taken a little bit of a hiccup in some of the polls, you are going to see it much more difficult to get, the bipartisan deal done, and it's even unclear how easy it's going to be to get reconciliation done. So I'm very concerned you're going to start seeing that time slip, so that it's going to be, further down the road that we get it. It's going to be less money. It's going to be less effectively spent. So I do not think the market's prepared for that. And at the other end of it, you're hearing much more noise, even from Treasury Secretary Yellen, about global minimum corporate taxation. So we could be in for a little bit of a policy hit, which we have not had in quite some time.
So, Pete, that's the analysis. Let's get to the market call. What is the market call?
I think you want to be cautious here. You start looking at some of those companies that will benefit if we get a slowdown, if we're going to do more work from home, if some of these jobs are going to go away, where are they going to be replaced? I like the idea of the robotics. So you look at that. I do think some of the sectors that have remained beaten down, you can still own energy, you can own, I love the MLP sector. I think that's going to do reasonably well in a yield-strapped environment. So you can look to that. I think bonds do okay. Corporate credit's going to do okay. So it's going to be a bit of a meh sort of environment, not great. And I do think you want to watch very closely anyone who could be under tax scrutiny, so very low global tax rates or U.S. income tax rates on a corporate side, they could be in a little bit of trouble. And anything where the FTC might start regulating more heavily. I think we kind of all ignored the attacks on Facebook. That could become a little bit more frequent. So I'd be pairing gains in those. They've had huge gains, so it's time to take some gains there.
Just to be clear here, Pete, then, it's not an overall reduction of equity exposure per se. It's a compositional shift?
Yes, definitely much more compositional shift. And anything that's really domestic focused, I do continue to like. I think China's slowly separating from us. I think the supply chain problems are going to be an issue. So anyone who can help with the logistics or manufacturing in the U.S., and not heavy manufacturing, very light manufacturing, but the logistics around that, those companies should do very, very well as we see this shift and repatriation of supply chains.
What does this mean for yields?
I think yields do okay. I think we see a steepening of the yield curve because everyone is now convinced the Fed is not going to hike. I think we continue to see taper. And the real message
Wait, hold on a second, Pete. Not to interrupt you, but you said that people are convinced the Fed is not going to hike ever in this cycle, or not for a couple of years?
I think at least not for a couple of years, though increasingly I think the conversation is turning to what happens if we do get a downturn and we're already at zero. But that's not today's conversation. Maybe that's 4 or 6 months from now, or hopefully never happens. To me, the fiscal stimulus is going to be driving bond yields. If it does look like we get a decent fiscal stimulus package, bond yields can rise. If that starts looking to fade, I think bond yields can unfortunately go lower again, and I think we could see 1% on 10s. My call is for higher bond yields because I still remain optimistic. But more and more I'm getting conservative on what's going to come out of D.C. and what that means for the economy, for markets, and bonds.
Pete, you think we'll see one before we see two again?
Was that a Tom Keene impression?
Yeah, I would love to say no, that we're going to get stimulus, that the economy is going to chug along. But right now I'd have to say yes, 1% before 2.
Peter Chair of Academy Securities. If the guest gives you silence, don't fill it. Just let it breathe for a moment. 1% before 2, Lisa.
Yeah.
1% before 2. There you go. Pete, thank you. What a call, Lisa.
He's not alone. We're hearing this increasingly. PGIM Fixed Income has come out and said something similar. A lot of people coming out and saying buy the dip in treasuries, that basically any sell-off there is a buying opportunity. And that, to me, is one of the more fascinating calls to the point where the economy is accelerating to the degree it is.
A few more maybe joining the Jim Bianco camp there, Katie, just sort of questioning as to whether the Fed gets stuck down here for a while.
And there's a great piece out on the terminal today, John, about what the neutral rate actually is. How has our start changed as a result of this crisis? And if indeed it is higher, given how low we are now, what is that going to mean for monetary policy going forward and the ability for central banks to maneuver as we come out of this extraordinary period of extraordinary monetary policy?
We'll ask that question. We'll put that question to Megan Green of Harvard University. The senior fellow joins us very shortly on this program. In your equity market this morning, unchanged on the S&P to positive 0.04%, if you can call that a move. In the bond market, yields are higher by 4 basis points on 10s to 136.64. Crude a little bit softer, down by 1.9%. What was that, Lisa? You want to do that again?
I'm good, thanks.
You want a bit of sound disruption there? Oh, right. Nice. From New York.
I'm
this is
practicing.
Bloomberg.
会場に行って観戦するということも難しいお子さんがいるんです。このように冷房の効いた香港の体育館の中で、それこそ大会の最前列で観戦ができる、体験ができる、こういうことをとてもありがたいことだなというふうに思っていますし、この技術に感動しています。予想以上に子どもたちの反応が良かったというのはですね、とても校長として嬉しく感じております。この子どもたち、どれだけオリンピックの心待ちにしていたのかっていったことがよくわかるような今日の表情です。
From New York, heard on radio, seen on TV, this is Bloomberg Surveillance alongside Lisa Bravitz and Katie Lyons. I'm Jonathan Ferro. Tom Keane back with us in a couple of days. Your equity market looks like this on the S&P, basically unchanged, advancing a couple of points, up by 0.04%. Into the bond market with yield higher and the curve steeper, up 4 basis points to 136.64. A little bit of feedback from the audience, Lisa. Interesting how Ferro disappears and Tom is at work. Now Tom has gone and Ferro is working. Could it be they're one and the same? I mean, it is true, and I put this out on Twitter. We have not been seen in the same room all year. Who knows?
True. Yeah, I wonder the same thing.
Maybe I just play split personality on the program and run into the other room.
You look really similar.
Do a great impression.
I could see just,
We should share what Katie said when she sat in the big chair a little bit earlier this morning.
I have no idea what you're talking about.
Just a different kind of fit, wasn't it, Kaylee? Euro dollar 118.61, negative a tenth of 1%.
You're trying to throw us under the bus, John.
68. I wouldn't do such a thing. Crude down about $1 and change to $68.03. We're down by 1.8%. I'm moving on, guys. I'm not getting you in trouble.
I know.
Megan Green joins us now, Harvard Kennedy School senior fellow. Megan, it's been a while, but the story hasn't changed. In fact, the only thing I can think of that has changed is that we were all waiting for September, and now seemingly we're all waiting for 2022. What's your take on things?
Yeah, I think that's right. I mean, the big question remains whether there's going to be inflation and sustained inflation or not. And that question hasn't been remotely answered. There are data points supporting both sides of that story. We were all hoping a couple months ago that come September, kids would go back to school, we'd all go back to the office, events would happen in person again, we'd be traveling again, and that's clearly not happening. So unfortunately, I think we're going to have to wait a bit longer and ride out this Delta variant wave to see what the fundamentals really look like.
Megan, we spent the last couple of weeks having this discussion with economists who have all basically said, I stress all, perhaps the consensus is that this is a recovery delayed and not derailed. But Peter Scheer raised an important question about 10 minutes ago on this program as to whether the demand right now and the job openings in America, which are sky high, do stay that way into next year. And the longer they're left unfilled, that perhaps they do start to drift away and disappear altogether. Megan, you're an economist. What would your take be on that particular dilemma at the moment?
Yeah, look, I think that it depends entirely on the virus, as all things have for the past year and a half. But I don't see us going back to shutting down the economy the same way we had before, in which case demand shouldn't wane as significantly as some people fear. I think the much bigger concern is the supply constraint on workers. We saw that in the last jobs report. A lot of workers didn't want to go out and get jobs because they were concerned about the Delta variant. And that fed through into wage increases, which aren't necessarily a bad thing, but they do become a concern if they turn into a wage price spiral. I don't think that's happening yet. Average hourly earnings were up pretty significantly, but average weekly earnings were down a bit because hours have cut. So you need both earnings and hours to increase for it to maybe start to creep into a wage price spiral. That being said, companies don't have the same pricing power that they used to. Workers don't have the same power that they used to, negotiating power for wages. And so I just don't see that creeping in.
Megan, how do you view the recent slowdown, the recent disappointments that we've seen in economic data? Is this simply a result of the Delta variant and we'll see renewed growth later on in the year, renewed momentum? Or is this something different, as Pete Scheer was talking about?
Look, so from the very start of this pandemic, I've suggested the recovery might look like a Nike swoosh with a zigzag on the end of it. And I think we're seeing a bit of that zigzag like we did previously with shutdowns and reopening. So I think a big piece of it is the Delta variant, but I've also thought we'd get this bounce back and then a long, hard slog. And I think that might be creeping in as well. So we've had kind of the brunt of the bounce back. We might get a bit more as we end up on the other side of this variant wave. But of course, new variants might come out as well. So I think it's a bit of both, not to give you a typical economist two-handed answer.
Well, but then there's this other question about the supply chain disruptions, which you mentioned. And one of the biggest port operators came out over the weekend and said, actually, the problem is there's just too much consumption, that people just are buying too much stuff, and that's fueled by the stimulus checks that they've gotten. Do you think that that ultimately will be the solution, that people will have to buy less stuff, which is exactly what the economy does not necessarily want, or certainly nations do not want to see, because they want this momentum?
I don't think that's the concern, actually. I think when demand is there, then companies do tend to invest and ramp up the supply chain. So I think that's much more likely than that consumers have to just consume less. We might see an increase in prices, and we have seen an increase in prices in the meantime. But again, I think that is a question of sorting out some of these supply chain constraints. But I think that's the piece that will shift, not the consumption side.
Well, Megan, if you look at the bond market and the steeper curve today, it might be indicating that the market thinks that the Fed is going to let inflation run too hot for too long. Is there a risk that the Fed pushes out action too far?
Yeah, it could. I'm not at all worried about it. I mean, the Fed has undershot its target for so incredibly long that it's going to have to overshoot for a while. And as I've highlighted, I think there are a number of big structural drivers that have produced disinflationary forces on the economy. Things like market concentration, lower worker power, digitalization, automation. They've all been turbocharged in this pandemic, and they're keeping upward pressure off of wages and prices. So I'm not worried that inflation is going to run away and that the Fed's going to have to go ahead and catch up like it did in the 1970s. I don't think we're facing the same environment then. I also don't think bond yields will stay up for that long. I think we are very much stuck in this lower for longer world. The one thing that could change that is if we get all this stimulus and it is used for productive public investment, in which case that's a great thing, right? That will fundamentally increase the long run neutral rate. That would mean that we have much more room in terms of monetary policy maneuvers in the next downturn. That would boost productivity growth. And so that would be nothing but positive.
Where is the neutral rate now, Megan? What is R star?
I mean, it's like describing the smell of coffee. Nobody really knows. It has been incredibly low for decades now. There are disagreements on how to measure it. I would say it's slightly above zero, and it may have increased a bit because of the digitalization and automation during this pandemic, as I mentioned before. But I think the brunt of an acceleration in productivity growth and therefore an increase in R-star will have to happen off the back of massive infrastructure spending plans, investments in human capital. And we think those might be coming, but none of it has been fully legislated yet. So we're still going to have to see. And again, this won't be an immediate effect. I think it's going to be a bit of a slow burner. So it might take a while for that to feed through into productivity growth and a higher long run neutral rate.
And Megan, let's ramp up the coverage going into the ECB. Is that a live meeting?
It's a live meeting insofar as I think the ECB may well announce that they're going to slow down the previously accelerated purchase of assets under the PEP program. It's not a live meeting in terms of a fundamental shift in the ECB's thinking, though. Inflation is really high for the Eurozone. I would imagine the ECB is celebrating that. They've done an even worse job of hitting their inflation target than the Fed has over the past 15 years. And so I don't think that will represent a shift in ECB thinking or a concern that they actually need to go ahead and pull away monetary accommodation quickly. I think it's just a reflection of higher inflation. I think it's probably appropriate. They had earlier this year agreed to buy more assets every month than they had expected, and they're just ramping that down a little bit. I don't think that they'll suggest that they'll continue to ramp down those purchases, and I don't think that they'll suggest that the PEP program, which is currently due to end in March 22, will end then. I think they'll keep that off the table in the discussion at their next governing council meeting.
So you think that basically this is a bluff? The ECB members who have been coming out and saying it might be time to start at least talking about tapering as a result of the inflation rate?
Yep, I think this is a tweak that we might see if they go ahead and do this. And I don't think this fundamentally means that the ECB is thinking about inflation or economic growth any differently than they have been.
Megan Green, where's good to catch up? It's been too long. Megan Green there of the Harvard Kennedy School, the senior fellow. Lisa, I don't know if it's a bluff. It's just the Hawks might not be able to get what they want from President Lagarde at this particular meeting.
Yeah, but even there seems to be a desire to get the conversation going, and to not have the conversation at all, to me, shows that, frankly, those hawks, quote unquote hawks, don't really have any power whatsoever. I mean, honestly, again, this goes to credibility, this goes to unity in the ECB, and how much that contrasts with what we're seeing for the Federal Reserve.
There are doves and there are super doves. There are no hawks in developed market central banks. It's just, my rant from a few months ago, and I think it sticks. I don't know, whistling in the wind, apparently. I'll do a little bit more of that at the top of the hour if you want to tune into Bloomberg TV for the Open. Canaccord Genuity, Chief Market Strategist Tony Dwyer will be joining us alongside Erin Brown of PIMCO and Larry Adam of Raymond James. Looking forward to that chat with Tony, a market historian, Katie, looking back at these huge gains we've had so far this year. We had that from Dave Wilson, our stocks editor, a little bit earlier this morning. What happens after a 20% move through much of the year? Do you get a repeat of 87, 29? I think that's a little bit too dramatic, but do you get a pullback?
Yeah, I mean, the jury's out on that because looking back at history, it really has been a mixed picture when you have 20% run in the first 8 months of the year. But we also have to keep in mind, we've seen 54 record highs on the S&P 500 this year. That is a record of records through any point of August of any year. And we have, John, I went back and looked at the number. I believe it is 211 trading days without a 5% pullback. I mean, how long can that realistically last?
No idea, but price shapes narrative, which is why I always say it's easy to come on the show and say buy the dip, and we all sit here and say, well, that's obvious, buy the dip because the market's going to keep going higher. When you do get the 5% move, maybe even when you get the 10% move, it is always easily confused with something much, much worse. And Lisa, it's very quickly quite difficult to actually buy. It does actually take some confidence to sit here and say, you know what, I think it will continue. Because if we do get that move lower, it will come at a time when we're seeing decelerating growth in the United States. So it's pretty easy to build a bearish narrative off the back of a price move lower, given the environment we're about to go into year end.
Agreed, which is the reason why I actually do buy the argument. How fragile is this market? How much leverage is there in this market? How much are people trying to hedge against this or not? And perhaps that shows the vulnerability to some sort of disruption, which might be more telling than any sort of potential disruption that we can't foresee anyway.
I'll give it to you. It took 2 hours and 41 minutes to sound relatively bearish, Lisa.
I try.
It's not bad. Tom clearly does a better job of winding you up than I do.
No, don't worry.
That's official.
You wind me up.
I'll keep
plenty.
trying tomorrow.
Don't worry.
The S&P unchanged, yields higher by 4 basis points from 10s at 136.64. That's your promo for tomorrow. Don't miss it.
Oh, dear Lord.
From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden needs Democrats in Congress to give him a boost by passing his $4 trillion economic agenda, but divisions in the party threaten the chances of that happening anytime soon. Democratic progressives and moderates are at odds over the size of the tax and spending package. Meanwhile, there's a battle coming up with Republicans over raising the debt limit. It's one of the most contentious issues of Brexit. The UK has extended post-Brexit grace periods for trade between Great Britain and Northern Ireland. British officials want the EU to rewrite a part of the Brexit deal that effectively keeps Northern Ireland in the bloc's custom area. State Street has agreed to buy Brown Brothers Harriman's investor services business for $3.5 billion in cash. The firm is adding an operation with $5.4 trillion in assets under custody. State Street says it's now targeting a pre-tax margin of 31% because of expected earnings growth from the acquisition. The world's largest interdealer broker is slamming the idea of working from home. The CEO of TP ICAP, Nicholas Bretto, says the firm needs its clients to work more from the office and take more risk positions. TP ICAP's brokers have been told to come back to the office full-time in places where it's safe to do so. Bitcoin faces the biggest test yet in its 12-year history. El Salvador is becoming the first country to adopt it as legal tender. The country bought 400 Bitcoins ahead of the rollout, worth about $20 million. The question is whether a significant number of people want to do business with Bitcoin when it circulates alongside the US dollar. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
There is a really big disconnect between the economics, which are coming in weaker because of supply chain issues and COVID issues, and corporate profits, which are coming in much stronger than anticipated.
The bulls are getting more bullish even as we get some weakening data. Jonathan Golub there of Credit Suisse, Chief U.S. Equity Strategist and Head of Quantitative Research. There is a question going forward about China, the world's second biggest economy, how much it's slowing down, how much the government is allowing the economy to slow down after paring back stimulus, trying to tighten the market, including property markets earlier in this year, now questioning perhaps whether they're going to reverse that. Joining us now to speak about this is someone with intimate knowledge of China and, frankly, the difficulty as well as the potential successes of organizing events there. Andy Brown, editorial director of the Bloomberg New Economy Forum, joining us right now. Andy, I want to just start with the import-export data overnight, the idea that we got a record number of exports from China at a time when people were expecting a slowdown. Do you view this as perhaps more strength in the economy there than perhaps people were giving credit to?
Well, look, we've had we've had shocks coming out of the Chinese economy to the extent that they are pushing ahead with this COVID zero public health policy, where you had one infection in the port of Ningbo and one of the world's largest ports closed down several weeks ago. You had the same thing occurring in Shenzhen. I mean, China is responsible at the moment for a good deal of disruption in the supply chains, which is showing up in the U.S. in the lack of supply of goods and inflation.
Andy, I'm sorry to cut you off here, but there's a question. There was the expectation that some of those shutdowns that you're talking about would actually put a damper on some of this export data, and yet it did not. Does that signify that perhaps people are overstating how much of a disruption their COVID zero policies really are?
Well, it may be, but if you talk to exporters, if you talk to shippers, if you talk to people in the supply chain industry, they're all saying that they're facing unprecedented costs for shipping containers. It's impossible to, all the boxes are in the wrong places. And in time, this indeed is going to show up in increasing disruption to the supply of the type of goods that are coming out of China. One can see it. I see it here where I am in New Hampshire with shelves empty, in the big department stores.
Obviously, you have the growth equation in China. Then you also have the regulatory crackdown on many different sectors. Lisa alluding to what's happening in the property sector, but you also have education. You have ride-hailing services. It seems never-ending, and there is a question of when that actually is going to start winding down. Is there a risk that the Chinese regulatory crackdown exacerbates the already existing growth slowdown?
You know, there are big unanswered questions about where this regulatory crackdown is going. If they're very serious about reducing inequality in the Chinese economy, and Xi Jinping, and this is at the heart of his crackdown on big tech, he calls it a drive for common prosperity, the growth in China is going to take a hit, particularly if he goes after the property sector, which is far and away the biggest driver of inequality in China today.
Is the shift toward the pursuit of common prosperity a revolution of some sort, or is it just a shift in rhetoric?
You know, it's really interesting that within the investment community, global investment community, you have quite divergent views on what's happening. The most benign interpretation is that Xi Jinping is taking on the big tech monopolies to address problems that exist in many countries around abuse of consumer data, underpaying of gig workers, not paying their fair share of taxes. The other view, which investors like George Soros are taking, is that what we are seeing is an all-out assault on the private sector in China, and that indeed at a high level it represents a clash between free market democracies of the West and authoritarian state capitalism in the East, and that this battle is now reaching a crescendo. And under those circumstances, it's irresponsible to be investing money from U.S. consumers in the Chinese market.
So let's go there, Andy. The fact that you mentioned George Soros, who did write in the Wall Street Journal, pouring billions of dollars into China now is a tragic mistake. It is likely to lose money for BlackRock's clients, and more importantly, will damage the national security interests of the U.S. and other democracies. Do you think that George Soros, putting aside the fact that he is somewhat of a polarizing character, do you think that he represents an increasingly mainstream view that it is becoming a political liability to invest, to plow money into China right now?
Well, you know, George Soros is not the only voice who is sounding a warning about what's going on. Masayoshi Son, who's been investing in China tech right since the beginning of the cycle, has said that he's taking a pause. Fund managers in the U.S. are getting out of the China tech sector altogether. And I think that this represents a real confusion over where this crackdown is going.
Andy Brown, thank you so much, editorial director of the Bloomberg New Economy Forum. Really interesting. And Kaylee, you keep discussing the property issues. I got to say, that is perhaps an understated risk considering how much that particular sector has been inflated and how the Chinese government has been increasingly willing to allow the deflation in at least asset prices, even as people start to worry, this might have broader consequences than perhaps they're expecting.
Yeah, I mean, Evergrande, case in point, we were speaking with Damian Sassower of Bloomberg Intelligence of this earlier. The world's most indebted property developer that is continuing to deteriorate, just got downgraded, and there's a risk of the spillover effect broadly in China credit, and that could ripple really across assets across the world. And the question, Lisa, is, can you buy the dip in China? We've been talking a lot about how buy the dip seems to always work, at least in the equity market here in the U.S. And yes, the valuations are much more now attractive when it comes to some of these Chinese technology companies. But can you actually come in and buy them at this point when the regulatory question is still hanging in the air?
And then, of course, there's also the flip side over in the U.S. We're not talking about Washington, D.C. that much. What kind of could get passed on the fiscal front, and how much does that have an international ramification in terms of the goods being purchased? Right now, just taking a look at at markets ahead of the open, we do see basically nothing going on. God, Kaylee, these days, I mean, it doesn't feel like it is post-Labor Day. It feels like we're still at the end of August, barely moving. S&P futures basically flat. Euro a little bit weaker versus the dollar. 10-year yield definitely the most interesting as we get that deluge of bond sales globally this week. Coming up on Balance of Power, former Council of Economic Advisors Acting Chair Tyler Goodspeed. From New York, this is Bloomberg.
I'm Andrew Krasny with an exclusive U.S. Open update for Bloomberg TV and radio from Tennis Channel. British teenager Emma Raducanu reached her first quarterfinal at the majors on Labor Day in New York City. The 18-year-old became just the third qualifier in the Open era to reach the Elite Eight at the Open with a devastating straight sets win over American Shelby Rogers. After going down an early break, Raducanu took 11 games in a row on her way to the biggest win of her life, dropping just 3 games in the victory that took just over an hour on court. The Brit moving on to face Olympic gold medalist Belinda Bencic for a spot in the semifinals. Raducanu isn't the only teen in the Elite Eight. She joins Canada's Leylah Fernandez, who turned 19 on Monday. And don't forget, you can watch all the action from Flushing Meadows every night on Tennis Channel. I'm Andrew Krasny.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Happening on the ground right now, just in terms of consumer price tolerance?
We see a strong consumer right now, and you can see that even in the early starts to back to school and back to college season that we're really pleased with. And I think if we step back and look at the quarter, you know, we see the evidence of that strong consumer.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Yields are higher, the curve is steeper, the equity market is not doing much at all. From New York City this morning, good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue. September gets an early downgrade.
Payback came early.
Q3 was definitely weaker.
September is a really critical month.
A whole bunch of things going on there.
Post-Labor Day was the game plan, but
the Delta variant.
There's payrolls report, no loss of benefits.
It started the new school year as a bit of a wild card. A lot of companies are starting to push back that back to office. Major corporations have certainly pushed off their kind of full return to office.
You have, to some degree, given the Fed some ammunition to not taper.
There was clearly some slowdown.
You had to downgrade growth a little bit.
So much talk of a weakened market in September.
Payback has been fast and furious.
From New York, joining us now, I'm pleased to say, is Larry Adam of Raymond James and PIMCO's Erin Brown. It is September 7th, and already, Erin, it feels like we're de-emphasizing the importance of the month ahead of us. Are you?
No, I'm not. I think that the month ahead of us is going to be a critical month for markets. I mean, we have a lot of events on the calendar. We have the Fed, which is likely going to pre-announce the announcement of the end of the start of tapering. We also have a fiscal sort of cliff, or at least a negative fiscal impulse ahead of us as unemployment and benefits start to roll off. And of course, we have, the last couple of months of the year, which always tend to be, a critical months for markets. That said, I do think that we're in an environment still that is very positive in terms of the backdrop for equity markets and for growth. Yes, growth is gradually starting to slow, but it's coming off from very, very high levels, which we have to keep in mind. And we also have to keep in mind that household balance sheets and corporate balance sheets are flush with cash right now. There's about $5 trillion sitting in money market funds, which is waiting on the sidelines to get invested in markets. So I think all of this augurs well for equity markets into the last quarter of the year.
Larry Adam, do you share those views?
Yeah, I absolutely believe that September is still going to be a critical month. I mean, first of all, we're going to get some more signs on what's actually happening with COVID. Do we get the booster shots? Do we see a cresting in the number of new cases? I think that's important from an economic perspective, as Erin said. Clearly, the Fed continues to be front and center. I still think they're going to be on pace to announce something in November and do something in December. And then I think you got to remember that Washington is going to start to heat up. And what do we ultimately see with this fiscal stimulus package that they're talking about when it comes to the infrastructure packages? So I still think that September is a critical month for the markets.
Let's bring in Tony Dwyer of Canaccord to ask him the same question. Tony, your view on that. Do you share Larry's view, Erin's view, that this month will be a critical month for markets?
Well, I think it is, John. I think we're in this middle of this transition phase from peak everything into a normal self-sustaining cycle. Again, as you know, I think one of the hallmarks of the transition is what happened in the summer of 2004 and the summer of 2010. And I think it's been very similar, with the exception of the top FANG stocks. The mega cap stocks have held up the indices, while everything else has been in this summer of indigestion. So I think September is going to be transitioning from that, the troops may catch up to the generals into year end.
Let's bring in Michael McKee for more on this, our economics editor. Mike, the road to September 22nd, walk us through it.
Well, right now the road gets a little rockier because this is the day that all the pandemic additional jobless claims benefits fall away. And a lot of people go off the cliff, as it were. About 8 million people are going to lose extra benefits, including the pandemic emergency unemployment compensation. That was the longer term benefits for people. Pandemic unemployment assistance, that was for the gig workers and contractors. And then that $300 federal supplement went away. So according to the Century Foundation, that's about an $8.2 billion hit to the economy each month. And we'll see if that happens when we get retail sales figures later this month. We have a busy calendar Not this week, next week. But this week, we do have some things that will be making news. The JOLTS report is always interesting, but it's 2 months behind. So it's not going to tell us about where we're going in September. The Beige Book May will get anecdotal view of what's going on. And John Williams is speaking. There's a number of Fed speakers this week, but this is the one to watch because he's one of the big three, the president of the New York Fed and vice chairman of the Open Market Committee. And what he says is probably what Jay Powell is thinking. Thursday is jobless claims. And then you mentioned it at the top of the show, back to school. A lot of states have their kids back in school already, but for the rest, by the day we get to Thursday, then all the kids are back at school. And that was the moment we were waiting for to see if women go back into the labor force, in particular, the people who are carrying the load with staying home for the kids. Friday, PPI expected to be big. We do have that inflation indicator. And here's something else. Usually the second Friday of the month, the Atlanta Fed puts out its sticky wage tracker. And a lot of people might be watching this month because, as you can see there, it's rising, but not as much as average hourly earnings. And what's rising is the lower end. So we'll see the low skill end. We'll see if there is an effect of composition in the average hourly earnings gain we saw last week, or if it is simply that companies are paying up to try to get workers. And now there's going to be, John, a lot more workers available who won't be getting unemployment benefits.
Mike, thank you. The things to look for the month ahead, the road to September 22nd, the next Fed decision. Goldman out early with another cut to their GDP forecast, specifically for 2021. They're looking for 5.7 from 6, the smallest upgrade for 2022 to 4.6 from 4.5. Here's the quote. The hurdle for strong consumption growth going forward appears to be much higher. The Delta variant is already weighing on third quarter growth, and fading fiscal stimulus and a slower service sector recovery will both be headwinds in the medium term. Tony, I want to bring you straight back in. That call from Goldman, does it resonate with you?
It does, and I think it's a perfect setup, John. I remember coming into the spring and actually early summer, the vaccinations were becoming broad-based and people were much less worried about getting sick. You had historic economic and earnings growth directly in front of you. You had the emergence of the fiscal stimulus that was going to make it even more dramatic. Everything was so exciting economically and even in the market. The broad market was making new highs, not just the S&P 500 or major cap-weighted indices. That was the time to worry about the average stock. That was the time that you saw the peak performance of the economic recovery theme. So maybe if the excitement going into late spring was the peak for the economic recovery theme, maybe in September, as we get the Delta variant, we roll off, as Mike just said, the extra wage benefits, unemployment benefits. Maybe the slowdown from peak everything and the underperformance over the last 3 months of the cyclicals, maybe that sets the stage for a year-end opportunity in the economic recovery theme.
Question I've been grappling with, guys, is whether it's recovery delayed or recovery derailed. And Larry, to turn to you, to go back to that Goldman call, 5.7 from 6 for this year, but next year the smallest of upgrades to 4.6 from 4.5 for 2022. That speaks to delayed and not derailed. And I sense from your early comments, Larry, you share that view too.
I do. I don't think it's derailed. First of all, I think we need to put it into perspective. When we came into this year, most consensus was looking for about a 4% GDP for this year, right? That's been revised up systematically throughout the course of this year. So just bringing it down a tad, to me, doesn't derail anything. And when I look at a lot of the real-time indicators that we look at, we still have a healthy trajectory ahead of us. Everybody wants to talk about the employment numbers and how they came in and were disappointing. But we look at withholding taxes, and that's one that you really can't fake. It comes out, the government shows it to us. It's at record highs, and it's growing year over year at the fastest pace since 2013. That tells me that the employment conditions are healthy. It's more about the supply and getting people those jobs. It's not really the demand coming from businesses. Demand continues to be strong. So I still think this will continue in the next year. And in fact, as you mentioned, I think we're just going to continue to elongate this recovery that we're seeing.
So Erin, two-part question to you. I sense you also agree with Larry. You're speaking to the same themes. Why the barbell then, if there is this confidence that this continues into next year and beyond?
Well, first, I think you're absolutely right. I do think that what we're seeing is higher for longer. If you look at some of the reasons why Goldman downgraded their estimate for this year, but slightly upgraded their estimate for next year, is because there's supply chain shortages right now, which is crimping growth. And whether it's semiconductors or other raw material supplies, given difficulty with being able to source those products from abroad, what we're seeing right now is that it is putting downward pressure on immediate growth, and we're likely to see that growth because the demand is still there. It's a supply chain event. We're likely to see that growth in 2022 or at least later 2021. So really what we're doing is elongating the cycle. We're going to see higher for longer, and that likely does mean that the rally continues to extend into 2022. I do think that taking this barbell approach to investing is important right now, because I do expect that you will see some cyclical pickup into year end. So you want to be long the reopening sectors, which have gotten hit hard and have underperformed over the last 3 to 4 months as the Delta variant started to rear its ugly head. You also want to be long some of the infrastructure plays, which are going to benefit from the BIF package and from more infrastructure spending in the U.S. But on the other hand, I think staying long secular growers in the tech space that are innovating and continuing to outpace GDP growth, I think will also continue to do well in this environment as we move into the transition. So it's a way to really protect yourself into this transition, which is occurring in the economy as growth slows, but from a very high level. But at the same time, stay very fully invested in stocks.
Erin, you mentioned the Delta variant a couple of times there. Let's turn to our colleague, Abigail Doolittle, for a little bit more on that at the market desk. Hey, Abby.
Hi there, John. Well, this was supposed to be the big reopening week when all was improving with the pandemic, business getting back to usual. But as we know, that's simply not what's happening. In fact, we have some breaking news just a few moments ago that the U.S. Air Force says the vaccine is now mandatory for airmen and guardians. And a piece of this is the COVID curve simply climbing. In fact, so much so that Sweden last week banned U.S. citizens from entering Sweden. This chart that we're looking at right now, the yellow line, that's 75 people for 100,000. That's the EU limit in terms of what's acceptable relative to COVID. But the white line and the blue lines, the US and the UK, well above that, well closer to 600 cases per 100,000. Again, well above the limit. Interesting, though, if we take a look at the vaccine distribution, it's skewed toward the US and the UK. The U.S. has 7% of the world's vaccines, just 4.3% of the population, and that's true, too, for the wealthiest folks in the world. And the big question, you all were talking about that Goldman call not so long ago about the GDP being revised down. The big question is whether or not Delta will affect the economy. Goldman's clearly saying yes, now thinking that GDP will be 5.7% instead of 6%, saying that there is that harder path that you were talking about ahead for the U.S. consumer. So just when everybody thought that things maybe would go back to normal, curveball after curveball, John.
Abby, we keep pushing it back and pushing it back and pushing it back and pushing it back. Some good news out of AMC, though. For AMC, that stock is up by about 3.5% in the pre-market. The headline as follows: the Labor Day weekend attendance ahead of 2019. Larry, Adam, I want to come back to you and just press you a little bit more on this. The return to normal. I'm looking at airlines, flights. Things aren't getting back to normal as quickly as we thought they would be. Looking at what's happening with, say, cinema going, attendance there, things a little bit better for the likes of AMC. What's your read on that right now?
So I think it's actually been fairly resilient. I mean, last year at this time, we didn't have quite as many cases, and for the most part, we were shut down. So I think this economy is actually weathering this spike in cases that we've seen. And as we get further into this year, we get closer to the holidays, I think it's important for those numbers to continue to fall. And then I think that'll set up for a healthy holiday season, and hopefully we'll return much more closer to normal as we go into next year. And that's pretty important, because I still think that there's plenty of pent-up demand. I still think there's plenty of money in consumers' bank accounts. And I think we're ready to continue to see this continue well into next year. And when we look at our forecast for next year, as you were talking about, those Goldman forecasts, that's still almost double trend growth. While it's decelerating, that's still a fantastic year of economic growth from a historical perspective.
Airlines are still down by 22% from the April highs, Larry. Would you be positioning there? Do you want to buy that weakness?
No, I think we have to be careful with some of these reopening trades. And the reason I say that is that when I look at how much they have recovered, but you're still talking about a lot of those names not recovering their earnings from where they were pre-pandemic until next year. So I'd be a little bit more cautious there. As Erin was saying, I'd rather be in areas where I have the visibility of earnings, right? So that's more of your big tech. as we get some of the recovery with, for example, some of these industrial companies. They have much better visibility going into the future instead of relying a lot more on, business demand coming back and traveling, consumers traveling. So I prefer those other areas.
Hey, Larry, we'll build on that. Larry Adam there, alongside Tony Dwyer and Aaron Brown. Coming up on the program, supply chain concerns rattling the automakers. More on that conversation. Still ahead from New York City this morning. Good morning. As Wall Street gets back to work, 16 minutes away from the open and bound, futures doing absolutely nothing. The action is in the bond market. This is Bloomberg.
What do you predict the Taliban will do in the coming months and years?
I would say consolidation of their power and gaining international legitimacy and recognition. This is the priority for the Taliban, not supporting transnational jihad, not basically in any activities outside of Afghanistan. If you really watch carefully what the Taliban have done in the past few days, they are engaged in a public relations offensive. They are trying to convince the world. If you listen carefully to what they're saying, you think that the Taliban are newly born Democrats. They are peacemakers. And the reason why they want to consolidate their power, they want to convince the world that the Taliban have changed.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
In terms of the chip supply, we are fighting hard to get the right volume of semiconductors.
Semiconductors are in high demand.
The demand of semiconductors will be even higher in future.
And the capacity ramp up will take time.
We have to rethink the whole supply chain.
Shortages for the next months or even years.
It is more difficult. It's here to stay.
Probably a bottleneck for the next months and years to come.
Automakers growing more concerned over lingering supply constraints, with Qualcomm CEO taking a more optimistic tone, expecting constraints to ease by next year.
We put our scale to work. We have been investing with our suppliers in new capacity, and we expect material supply improvements as we get at the end of this calendar year. So we're going to enter 2022 with a much more balanced supply-demand equation.
Joining us now, the man responsible for many of those interviews, in fact, all of them, our colleague, good friend, my good friend, Matt Miller. Matt, walk me through the tone of that conference right now, that meeting.
Well, the tone right now is very political because Angela Merkel, the Chancellor of Germany, is headed to the IAA, to the Munich Auto Show, and most of the automakers there are looking for some kind of government support. They've invested billions. In the case of Volkswagen, some $70 billion. In the case of Daimler, almost $50 billion in shifting their fleet over to an electric fleet, and they want to gain some return. And yesterday, for example, I had dinner with Herbert Diess from Volkswagen, and he told me, look, as long as consumers are able to pay €1.20, €1.30 for a gallon of diesel, it's going to be hard to convince them to shift over to electric, especially since right now the charging station coverage is patchy at best. So they want to see some kind of support from the government for electric car purchases, as well as possibly even a boosting of the gasoline price, which is, of course, very politically dangerous for anyone running for office.
Matt, should we get to the important piece of this conversation? Is that a Lambo behind you, a Lamborghini?
It is a Lamborghini behind me. You see here the Urus, which has been a massive success for the company out of Santa Agata. I also am standing in front of an Aventador, and there's a Huracan inside. Stefan Winkelmann, the CEO of Lamborghini, who was the CEO of Bugatti, is going to come here in a few minutes, and I'm going to sit down and talk with them about the future of the auto industry for a car maker like this. Of course, these are fire-breathing internal combustion engines, but they've got to shift over to an electric powertrain, and they're probably going to do that with the help of Rimac. I just, by the way, spoke with Nico Rosberg, Formula One world champion. He told me he just bought a Rimac car. These are $2 million electric cars that do 0 to 60 in 2 seconds flat. So it'll be very interesting, at least for me.
I know Nico well. There's a man with some money. Matt, thank you. My producer just reached out, said SUV gross. I'm sure Matt Miller's got his own take on a Lamborghini SUV. You can hear him talk about that a little bit later through the day on Bloomberg TV, on Bloomberg Radio. Still with us, Larry Adam, Tony Dwyer, Erin Brown. Erin, we've been talking about where you want to take that cyclical exposure in this market right now. The orders have struggled, and not because the demand's not there, because they can't make the stuff. Where do you want to take that cyclical exposure on the one side of your barbell?
Well, I think autos are going to continue to struggle, as Matt mentioned, at least into 2022. And the reason for this is really their ability to source semiconductors sufficient enough to build their cars. And what you're seeing right now is a real bifurcation in the semiconductor market, where companies like Apple, like the Dell, like HP are able to get about 90-95% of their semiconductor chips that they need to produce. But the automakers right now are really struggling, only able to obtain about 70 to 80%. And that's going to continue to really weigh on their ability to put out products. So I think that autos is probably not where I want to be invested right now. You know, clearly they did well coming out of the March lows, but right now I think that they're going to continue to struggle into next year. I think a better place to invest right now is really looking at where the U.S. is likely to spend its infrastructure dollars, and that's really in green investing, in sort of upgrading the railways, roads, bridges, as well as water. I think that's also a good place to invest on the infrastructure side. And then on the more of the consumer cyclical side, I do like some of the leisure and entertainment names, and particularly some of the hotel names as well, as we start to see people return to a more normal environment into 2022. So I think both on the consumer cyclical as well as the industrial cyclical places, there's areas to play right now, but really you have to be much more specific about where you're placing your bets.
Tony Dwyer, same question to you. We caught up with Larry Adam about that. He's still with us, and we're going to run through the opening bow with him shortly. But same question to you on the optimal place to sit and take that cyclical exposure if you want it.
Well, I think it's going to be tied to higher rates. In terms of the barbell that Erin was talking about, I think it's more of a time frame barbell, where I think what you want to rent and into year end is the financials, the industrials, the materials, even the energy. I think we're going to get this perception of some of this negative news is discounted, as I said earlier in the program. Again, we know about the semiconductor chips today, and we also know that there's going to be a little bit of a postponement. We don't know. There's likely to be a postponement and maybe some of the taper talk with the Delta variant. In other words, interest rates are so low and financial conditions are so easy, and the news is so pervasive about past peak growth that I think it creates that near-term opportunity. But again, those low interest rates do support some of the larger cap, mega cap stocks going into next year.
Tony Dwyer, Erin Brown, Larry Adam, sticking with us. Coming up on the program, the morning calls, and later, the S&P 500 could be heading for its 8th consecutive month of gains. We'll talk about that next from New York. This is Bloomberg.
Neptune was discovered, everyone wanted to do it because it was this clear demonstration that you can use math to discover objects.
Unfortunately, since then, no major planet in our solar system has been found. But thanks to modern telescopes, thousands of smaller objects have been discovered in the past few decades beyond Neptune, called trans-Neptunian objects, or TNOs. And planetary scientists at the California Institute of Technology have noticed some anomalies with these objects. Their hypothesis? A giant theoretical planet beyond Neptune, Planet 9. And thanks to a new telescope, equipped with the largest digital camera ever built, we may be one sky survey away from finally finding it.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Minutes away from the opening bout this Tuesday morning. Good morning. Here's the tone of the market. Your equity market, the S&P 500, bit softer, lighter, lower, negative about 0.1% on the S&P. That's the story for the equity market. Muted price action, a bit more price action in the bond market through the past 24 hours. Following Friday's move, yields higher, curve steeper. You see that again this morning on 10s, up 4 basis points. On 10s on a 30-year, up about 3 or 4 and anchored at the front end. So yields higher, the curve just a little bit steeper. That's the price action. Let's get you some morning calls. First up, a call from KeyBank, upgrading Spotify to overweight. The analyst seeing improved monetization and unit economics. That stock is positive 3.4%. Your second call from Morgan Stanley, downgrading Johnson & Johnson to equal weight. Analyst Matthew Harrison seeing limited news flow in the midterm to drive shares higher. We're negative there about 1/3% to 174.43. And finally, UBS downgrading McAfee to neutral from buy. The analyst weary of its ability to show strong renewal rates at PC shipments slow. That stock is negative 1.41%. Coming up, the equity rally pushing onward with the S&P 500 going 10 straight months without a 5% pullback. We'll get you the data, the numbers, the stats. Up next on this program, your opening bell is just around the corner. Futures not doing much at all this Tuesday. This is Bloomberg.
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Kicking off a brand new trading week stateside in New York this morning. Good morning. 2 weeks of gains on the S&P. Looking to add some weight to that. Not this morning. We're down 0.1% on the S&P. Negative around 3 or 4 points. Really muted price action across the board here on the S&P, the Russell and the NASDAQ. There's the opening bell. Switch on the board and get to the bond market. Treasury softer, lower, yields higher. We travel north on a 10-year yield up 4 basis points. So 136.47, the story is not US-centric. It's in Europe too. It's the Italian bond market. It's the German bond market. Yields are higher going into the ECB meeting this coming Thursday. The euro's weaker, negative down 0.2%. Euro dollar 118.47. And in the commodity market, crude, we shave about $1 off WTI, $68 and about 20 cents. We're negative there, 1.5%. Let's get you to the market desk. They are your cross-asset movers with your stock movers. Here's Abby.
Well, John, you know, stock futures may be, or actually the index may be slightly lower at this point, but we do have some big winners to point out in the tech and media space, starting out with the shares of Apple up not so much, but up 0.3%. Of course, the biggest weight to the big indexes on the news that future MacBooks may get health sensors or basically biometrics. Tesla up even more, up 1.2% as that Munich car show gets going, and the importance of EV, as you and Matt Miller were talking about. Netflix up 1% on a price target raise over at Atlantic Equity, 780 from 690. Huge potential upside if they're right. And then Spotify, the big winner, up 4.6%. This as the stock has been upgraded to an overweight at KeyBank, saying that this company has big momentum, even more so than YouTube Premium. As for some of the vaccine movers, Dr. Fauci is saying that Pfizer's booster is well ahead of Moderna's. We see those shares up 0.8%, Moderna down. And Johnson & Johnson was among Morgan Stanley's pharma downgrades today. So those shares are slightly lower at this point, John, fitting to the small moves to the downside for the major averages.
Abby, thank you. And well said. Bit of a nothing move on J&J. Similar move for the broader market. The S&P down, negative by a little more than 0.1%. Top of the pile, consumer discretionary. That industry group extending its gains by about 0.2%. Utilities negative 0.6%. Early days. Over the last year, though, the story's clear. It's 210. That's how many days we've gone without a 5% pullback on the S&P 500. For more, let's get to the market desk. On this rally, it's Katie Lines.
Well, John, it's been quite a rally and really a highly unusual one in that it's so rare that we go this long without a 5% pullback. And to some looking at this equity market, that means we are overdue for a bit of a drawdown here. Of course, this is coming after we've rallied 20% so far this year, up 8 months in a row on the S&P through August. And there's only been a handful of times in history we've seen a rally of that size through this point in the year. And the remaining 4 months, history tells us could go either way. Thanks very much to Dave Wilson for this chart, which shows that we've seen a mixed September to December performance throughout those years, though 1929 and 1987 are pretty big outliers there. So we'll see what 2021 will bring and whether equities can continue to climb to new all-time highs. Remember, the S&P has already hit a record 54 times year to date, and it is only September 7th. That is the most records of any year on record through this point of the year. In 1995, we had 52 all-time highs up to this point, and that year resulted in 77 records. And that finally, as for the sector performance, what has fared especially well in this year's rally? You do have cyclicals like financials on the leaderboard. The bank's up 28.5% year to date. Energy is up there too, though it has given back a pretty decent chunk of its gains. And John, tech is also represented on this list. The best performing level 2 industry group in the S&P 500 is media and entertainment. That is where names like Facebook and Alphabet live, John.
Kenny, nice, thank you. What a run it's been since the start of November last year. Canaccord's Tony Dwyer looking for stronger returns in the near term. He writes the following: the data of market performance following a streak of 7 positive months reinforces our view that the summer of indigestion should be followed by an opportunity into year end. Tony's still with us alongside Larry Adam, I'm pleased to say, together with Erin Brown. Tony, let's start there. You're a market historian as well. Does any of this data, these statistics, these records, do they matter?
Well, momentum tends to carry itself even further, a lot longer than you think it can. So when I look back at that data, what it does suggest is in all but 2 of the 13 occurrences where you've had 7 consecutive up months in the S&P 500. In all but 2 of them, in the next, it was a median of 17 trading days, you could have bought the market a little bit cheaper, ranging anywhere from 0.5% down to -6%. So the indigestion could carry forward a little bit longer. We're seeing kind of the sense of it a little bit today. But then again, I think you want to use any weakness that comes into play as an opportunity to get into that economic recovery theme going into year end. Again, because we knew in the beginning of the year, things were great. Things were going to be strong. The earnings were going to ramp. The economy was going to go up and the stimulus was coming in. It's the opposite now. That was the time to fade the economic recovery theme. So maybe the summer of indigestion, when we come out of that, may be time to position into that theme into year end.
Larry, let's build on this just a little bit more, shall we? We came into this year exactly as Tony described, and the bulls just weren't bullish enough. This market is absolutely ripped. Now we face this really interesting dynamic where growth could be decelerating, but inflation rates could persist. And a question I keep leaning on, going back to, in that environment, and I'm very hesitant, in fact, outright reluctant to call it a stagflationary environment, but in the environment I described, Larry, of persistently higher inflation and decelerating growth, what should I be owning in this market?
Well, first of all, I think it's too early to call it stagflation. As I mentioned, demand is there, and a lot of these inflationary pressures are coming from supply. So I think demand is there, and you want to be in areas that can, A, increase their pricing power so they can raise their prices, and B, have that visibility in earnings. And that brings us back to the same areas we've been talking about. I still like big tech. I like consumer discretionary, financials, especially if interest rates at least rise modestly. And I like industrials. The other thing that's very important is that you have to remember that these earnings have been coming in much better than what people have expected. And I think that that trend's likely to continue for the remainder of this year, which means that those PE multiples that everybody keeps pointing to are actually artificially inflated. So I actually think valuations are a little bit more attractive than what people think. And then the other thing I would say is that be in areas where this cash flow leads to these shareholder value things, such as buybacks, such as dividend increases, because under the surface, that's going to continue to support a lot of these sectors that I just mentioned.
Erin, can I come to you on the same question, please, and throw in that word, stagflation, which is getting thrown around a lot recently?
I think it's way too early to call stagflation as well, similar to Larry's thoughts. I think that when you look at growth, yes, it's slowing, but it's slowing from very, very high levels. And we're still in an environment where we're running above trend GDP. Inflation is likely to lag a little bit as we see inflation, peak over the coming months. But that's largely, again, driven to supply constraints. And I do think that as we move towards the year end of 2022, so into next year, we're going to see inflation back around the low 2% level. And so we will see some of these inflationary pressures start to roll off. In fact, when you look at what's driven inflation most significantly over the last couple of quarters, it's been in the auto sector, new and used cars. And you have now started to see that peak. It peaked 1 to 2 months ago. And you saw that in the most recent data. So some of the really significant drivers of inflation are already behind us. And yet we will continue to see inflation persist a little bit higher over the next couple of quarters. We're nowhere near, in my mind at least, a stagflation environment.
I share the frustration you have with the S word. Let me be clear about that. Tony Dwyer, hard to use the S word if you lean on Goldman's forecast of 5.7 GDP growth this year and something in and around 4.5 next year. The stag part doesn't quite work there, does it?
No, it does. People forget, when you look back at the market in the late 60s into early 80s, it wasn't just stagflation because the economy was hot. It was because you had multiple oil crises, right? So it wasn't just economically driven with the absence of any other geopolitical issues. You have to look at the price of oil and what was going on in OPEC at the time, which had driven gas prices up. And we all know the pictures of the lines at the gas pump back in the 70s. So again, I agree with Larry and Erin. I don't think stagflation is going to be the call. And frankly, each time we've come out and created a new economic cycle, and each of the last 4 cycles, John, you've had an extraordinary stimulus from the Fed. You've had fiscal stimulus come on board, record corporate credit new issuance. You'd have unbelievably easy financial conditions. That's not the recipe for a real slowdown in growth. So again, I think we do have growth going into and through next year. We're still early in the economic cycle. I don't think we're late in the cycle.
Just to run through the price action at the moment, we are declining this Tuesday morning by 0.2% on the S&P 500, on a Russell advancing by almost 0.2%, the Nasdaq positive by 0.11% to be precise. Another thing I think the four of us can all agree on is at some point we will get a 5% drawdown. That's not controversial. I mentioned a little bit earlier this morning on Bloomberg TV and radio that everyone's got a plan to buy that dip until they get punched in the face by a market move, referencing the great philosopher Mike Tyson. And Larry, I want to come to you on that. How you distinguish between a 5% move that you should buy and something that's the start of something much more sinister that you should avoid? Because a lot of people have the plan to buy that dip, and then it happens, and then they start to look around, and they start to see signs of decelerating growth, and you can see how people will get pretty fearful pretty quickly about a market drawdown from some pretty lofty heights that we're at currently. How do you distinguish between those two things, something to buy and something to run further away from?
So I think you bring up a good point, right? Pullbacks don't happen just so all of us can get into the market at cheaper prices, right? And you're right, everybody tends to get nervous when you see a pullback materialize. But I think it's important to keep perspective on this, right? As you mentioned, we've now not had a pullback in 10 months. That's the second longest period of time without a 5% pullback over the last 25 years. So that's significant. So we're probably going to have one. But if we get one in the range of 5 to 10%, we've had almost 60 of them over the last 25 years. The average time to recover those losses has been 2 months. When it's been between 10 and 20%, the average time to recover has been about 5 months. So you really run into the problem when you get them more than 20% declines, because historically they've coincided with a recession. And right now, as we've talked on this show, we don't really see any signs of a recession. So that's why, A, I would remain invested, and B, if you do have some cash, start to redeploy that into the areas that we see good earnings momentum going forward. Again, tech, industrials, financial, those are the areas I would continue to look at if, in fact, we do see that pullback.
Tony, same question to you.
Well, Jen, I think we have to define the market. If you're defining the S&P 500, if you get a 5% correction, I love the quote from Mike Tyson, too, because it's so true. And we see it all the time where people like me come on TV and tell you to buy the dip until we actually get the dip, and then we run scared. I don't think the financial conditions, anything that's happening in credit, means that I think you should buy that dip. Remember, you have a recession and a sustained bear market. You know, as Larry said, you get a bounce back typically pretty quickly from corrections. You get a sustained decline in the equity market when you have a shutdown of credit that creates the perception that you're going to go into a prolonged economic downturn. There is nothing going on in credit at this point that suggests that. Could you have a little bit of a tightening or worsening of credit from a historically easy level? Of course, and that could add into the whole theory of correction. But I think, again, as long as credit's okay, history shows you absolutely want to buy any dip of greater than 5%, even if it gets up to 10%.
It's okay in the US, not so much in China, but that's another story. Erin Brown, final word.
No, I think you're absolutely right. I think you have to look at the origins of the correction. And if the correction is being driven by technical factors because of position squeeze, I think you buy that dip. If there's been a fundamental shift in the underpinnings for your thesis on markets, that's when you get a little bit